Let's see. There we go. Here we go. AM Dizzle. Take a look at this. Absolute rocket ship today. 9% and huge upward revisions for growth. Something that you really have to know about AMD is AMD does a fraction of their business from data centers compared to NVIDIA. This is something we were talking about in the Meet Kevin membership in the Alpha report this morning. And it's something that, well, if we go to the Meet Kevin membership stock tab, because we have a stock tab so we can filter by AMD. And if we filter on the stock tab by AMD, one thing that I note here is that AMD's net income is still substantially lower. It's still 1/4 of what NVIDIA's is. But the thing that could be really nice for AMD, and we talked about this, about on the 4th here, on November 4th, we wrote that AMD, in my opinion, is still scaling out their data center sales. And the benefit of that is they're going to be able to butter out their operating expenses. As they butter out their OPEX, because they're able to sell more top line without necessarily their OPEX going up, I actually think their margins are going to improve substantially on the net. So, I was just doing some projections here. If they can maintain this growth, and based on what Wall Street is writing them up to now, on my multiple basis for this, it would be achievable that AMD could get to somewhere around $480, assuming, demand concerns don't crop up, which obviously has been everybody's concern, but then again, the AI keeps sort of impressing. So my take is that because data center revenues only represent, represent 46% of AMD sales, as they now grow data center revenue at, 80% plus, they end up buttering out their OPEX, increasing their net margin, which right now is just, 13%, which is 1/4 of NVIDIA. NVIDIA is 88% data center. So that's how they're getting these insane margins, because the appetite for data center is huge. So it just seems like AMD's gotten their hands on that manufacturing capacity. And so there's a lot of excitement and sort of a revision up that's happening on Wall Street. The previous growth estimate for AMD was actually much lower. This was recently, Wall Street numbers recently revised up, and the growth I was using was higher than Wall Street. Now, Wall Street growth estimates have shot past my estimates. So it's actually like Wall Street all of a sudden is turning really bullish on AMD. Now, for sort of movement in the day, something we talked about this morning is that in order to get the Qs to actually move up, my belief was, and we talked about this in the Alpha report this morning, my belief was that in order to get the NASDAQ to go up, you would need both NVIDIA and AMD to move up. And NVIDIA lost 196 hardcore, so it's not a terrible surprise that the Qs are actually down. So you've got a kind of a broader market that's quite red here. I mean, look at Circle's bleed out. Circle's bleed out here, this is on the week chart, is really just an example of a company that had this fantastic IPO hype. But this is what happens when a company has IPO hype and it moves on momentum. And unfortunately, it's probably going to be years before you really get these stable coins broadening out to mass adoption in markets. So you're seeing that pain at Circle. Now, something else that I think is just broadly wild to me is that a company like Simon Property Group, which is a mall REIT essentially, is at sky high levels. If somebody's like, Kevin, would you rather buy Simon Property Group or AMD right now? I'd much rather buy AMD. I feel like Simon Property Group is almost a short with the levels of where it sits and what I see at malls. Like, I can't believe malls still exist, but it's remarkable just how much competition there is for the consumer who's spending less money and malls. Whereas AMD really has an opportunity here to grow into this data center, sales business. So obviously we also had a presentation from AMD yesterday, and some notes from the presentation from Lisa Su. Lisa Su argues that they have, quote, very clear forecasts from cloud customers. In addition to that, they have OpenAI deal plans in the works. That's supposed to be later in 2026. Then we have, let's see, we will get enough supply. Okay, so she's confident on supply for production. That's why I think you're seeing some of these growth rates moved up as well. And the operating margin to get to 35%. To get to 35% is sort of in line with what I'm saying about buttering out these OpEx items here, which is great. Overall data center revenue growth, we see this. Inference is growing faster than training, which is also what you want to hear in sort of this more mature transition, right? Inference growing faster than training. She sees the total addressable market. I always get nervous when people talk TAM because it always, to me, aligns with like the top of the market. But TAM of over 1 trillion by 2030 for AI compute, which is just remarkable, given that, again, a small portion of their revenues right now, well, less than half of their revenues right now are data center related chips. She also says that customers are not leveling off AI investments. Customers not, quote, leveling off AI investments. Like, all of this is fine until there's really a market shock, right? All of this is fine until there's a shock. When stocks fall, the orders will slow rapidly. Because investors will start punishing CapEx spend. I think that's why you're seeing a sell down on Meta right now. And even to some extent, you've seen that on Microsoft. I mean, go look at Microsoft. So pop in over here to MSFT. And Microsoft, it's off of its all-time highs by roughly about 10%, which isn't that big of a deal. Like, it's still like, fine, obviously. I mean, they're doing great. They're nowhere near on sale like Meta is. Now, what's fascinating is Meta has already been one of the cheaper Mag 7 plays. I actually would argue that Meta is probably the cheapest Mag 7 play. And right now, off all-time highs, Meta is down about 23%. So that is really what you want to pay attention to, because Meta off all-time high 23% and MSTFT off 10%. If these are both, let's say, off all-time high by 40%, executives are going to start thinking CapEx is getting punished, not rewarded. And as soon as you get people on the inside that say, hey, we are starting to get punished for more spending, that's when the demand lever switches. Once executives think this, then the demand lever for chips rapidly flips. That makes year-on-year growth targets very hard to achieve for chip makers, or designers, I should call them, because you'll end up having negative comps, right? Negative comps will crash all AI chip plays. The thing is, right now, though, we're not seeing that demand slow. Why? Because stocks are still near all-time highs, with the exception of Meta. Meta, to some extent, is a little bit of a warning sign for CapEx spend. And it's really the first time that we've seen this outside of like Liberation Day, right? I mean, look, outside of Liberation Day, we've really not seen but a small hiccup over here. I think over here, Meta went from 520 to, what is this? The line right here. We got down to a close of 460, 520 to 460, 460 divided by 520. you're down about 11.5%. So outside of Liberation Day, this is the largest sustained decline for Meta since the chip recession, which is wild to think about. Let's write that fact down, okay? I mean, that's important to watch. Outside of Liberation Day, Meta has fallen the most, 23% now, since the chip recession in Q4 of 2022. If that continues, it's only a matter of time for investors to start to recoil against CapEx spend at other companies as well. I mean, to some extent, you're getting this frustration in CapEx spend also at CoreWeave. CoreWeave yesterday, we had this ridiculously awesome call. Like, I'm just really proud of it. I'm not trying to, like, pat myself on the back or brag about it or whatever. It was just, like, it was insane. But the fact that we were climbing yesterday at $98, I'm like, guys, I think this is going to 90. And then we double bounced at 90, and now we're breaking 90. Is not just a cool call, but it's also something that I'm very excited about watching, because we've got the MSA coming out. The MSA is wild, because the MSA is going to show us how much NVIDIA is backstopping CoreWeave. And so that's going to be something I'm watching for as well. Still no filing on that, so we'll see what ends up happening here. That'll be very interesting to watch. But longer term, I'm not the biggest fan of these chip holding companies, because I do think that, and if you watched my full video yesterday, you'd know. Some people just read the title, but that's pretty typical. But if you watch my full Michael Burry video yesterday, you see that I say Michael Burry is hands down wrong today, but he will be right in the long term. That's what's very interesting, is that in the long term, these will be bag holder plays. This is why when CoreWeave was under $40, I'm like, hey, this is going to be, like, this has really good potential in the short term to go up a lot, with NVIDIA basically being your put option, right? The long term is like 2+ years. These will probably all be bag holders. So, like, I actually have a little warning note on, I shouldn't say it, but on the Alpha report, I go, hey, like, long term, be careful about the bag holder stocks. And then I have a list of, like, the bag holder stocks. CoreWeave is one of them. So, if you reconcile what I say, it's like, hey, in the short term, you've got, like, you had great opportunity with a put option under 40 in CoreWeave. But long term, Michael Burry will be right in the long term. It's just when that curve of CapEx frustration actually hits. So for now, of course we don't see any slowdown. Of course we don't see any CapEx frustration at the vast majority of companies. I would actually go as far as saying that Meta and Microsoft are a little bit of canaries in the coal mine, which I think is interesting, because Apple is getting quite rewarded right now for not CapEx spending. Like, compare this right here, right? Apple is at all-time highs, and they are not, seeing any kind of declines now, because of this, lack of CapEx, in my opinion. And obviously good sell-through so far on the iPhone 17, with the exception of the iPhone Air, which the iPhone Air isn't great. I was really tempted by the iPhone Air myself. I'm like, oh, this is such a cool device. But man, it's like, am I going to spend that much money on a phone that now doesn't have the multiple cameras that you're used to now on the iPhone, and you're actually losing features? Doesn't make sense. So, you end up with the Halo iPhone Pro or whatever, which is just the orange one with the green case, right? But yeah, somebody here writes poor Air. I agree. Like, I thought it was cool. So, yeah. Anyway, somebody here says, I'm holding no bags unopened, all profits. Well, good for you. It ain't gonna last. But good for you. Yeah, I know an insider spent like $1 million buying yesterday because they're trying to pump the stock to get their stock comp. It won't last though. Insider liquidity trying to pump up Open Door we'll have a limited run rate. But anyway, so mind you, I was bullish on Open Door back when it was like 60 and 80 cents. We're like, hey, this is a good trend. This is a great uptrend. I started getting bearish when it got to like $6 though, in fairness, 5, 6, somewhere around there. So I realized it's higher than that now, but the big gains were up front. Now I think it's an extremely high risk play, very, very likely to bleed. So, like you should put on your calendar a year from now, what is Open Door? And it's probably going to be like sub $3. It wouldn't surprise me. Unless their fundamental business somehow transforms, which would be shocking. But anyway, so unfortunately, something we touched on this morning as well, just sort of short term here with the Alpha report, is that we really needed, we talked about this in the Alpha report, we need both NVIDIA to cross 196 and AMD to be up for the Qs to go up. Because AMD is just still a small portion relative to the weight that you get with NVIDIA. And so this frustration is very interesting to me. I would watch this, by the way, on a daily basis, this Meta over here. Now let's do a valuation on Meta just so you could see how its pricing is moving. So let's go jot down pricing on Meta. And let's go Meta. And let's see what they currently sit at. So if I dump this into here, I've got stock tab. Okay. And then let's go grab Meta. And let's see what we have. So Meta. All right. So Meta right now, I have them at a 1.16 peg, which is, I think, the cheapest of all the Mag 7s. I'm going to see what their financials are right now. I've got 28.6. Wow, okay, so they just had a little bit of a Wall Street write-down on EPS for the end of the year, so I will update that. 28.6. And then forward growth for Meta, I'm looking at 1584, 1435, 1199, 28.43 divided by 4 equals 1765. I've got them sitting here at 18. That sounds reasonable to me, so not a huge offset there. But if we jot that down, it's at a 1.19 peg right now, which is very low. 1.19 peg based on 18% growth. Wall Street is at 17.6% EPS growth next 4 years. So the 18% is sort of my rounding or estimate of it. But, one thing that Meta really has going for it, there's a duality here, right? So the biggest risk is Meta is the first you spend too much casualty. Now, part of that is probably because of Metaverse, probably due to Metaverse drunken sailor spending. And, Zuck also has this mindset. Zuck says, we'd rather overspend than miss, the opportunity, right? So that mindset has people thinking that, maybe he's careless with spending, is the mindset. Apple, all-time high. So, Microsoft CEO says, hey, we're fine even if OpenAI investment goes to zero, minus 10% off all-time high, right? Meta CEO, hey, we're going to keep spending even if it's wasteful. Okay, what do you have? Minus 2% off all-time high, right? Apple, just look at this contrast. Apple CEO, hey, we're doing nothing with AI CapEx. And then what is it? At all-time high, right? So look at that difference that's starting to brew. I mean, Apple's valuation right now, let's see what Apple is sitting at right now. Apple, for comparison, let's do Apple at 274 with 8.22 EPS end of, or that would be SEP 26. So that's actually going out a minute here. 274 divided by 8.22 of earnings per share. I've got 33.33 times. And then forward growth at Apple is, let's see here. Yeah, dude, not that great, honestly. So the next 4 years, I got 10.33, 9.35, 9.17, minus 1 divided by 4. I got 7% growth with 7% Wall Street forecast growth next 4 years. Well, what does that mean? That means Apple right now is selling for a PEG ratio of 4.7 PEG. Very high. So Apple, weirdly right now, is actually getting rewarded, whereas these others are getting wrecked. So, oh, wow. Jeez, nice. Somebody here donated $10. Just joined. Kevin gives the best takes. Fire. Saw your video on quantum being overvalued and bought some shorts. And you're up 50 to 80% since then. Dude, congratulations. That's amazing. And then Max here has a comment as well. Let's see what this is. Yeah, I mean, look at when you look at this, Meta is probably your canary in the coal mine for the AI CapEx cycle. And so while on one hand, I love that Meta is cheap and it's a beneficiary of the advertising cycle, it's Sonder BK story. Okay, we'll take a look at that. It could be a really big risk factor for a broader sell-off. I think really what you need is I hate to always go back to this. I feel like you need like jobs data to pump in Meta. You need something to pump Meta. Okay, so this, we'll call this a hot take, all right? So we'll go hot take. If Meta keeps falling, it's going to be the first casualty of AI CapEx and will be the canary in the coal mine. Other companies will want to prevent becoming a Meta and will therefore cut CapEx spend before Meta does. Now that probably creates a buy opportunity for Meta at some point. It likely wins from advertising revenues as, OpenAI, Copilot, blow money on ads. But, if they're going to get punished on the CapEx cycle, that is also going to become a risk for chips. So this becomes a lingering risk for chips. So ideally, best case, we crush the 3-month job data coming out early December. Meta recovers, and the CapEx cycle can keep booming. That's probably best case scenario. I think that's honestly asking a lot right now. So, if you're buying the dip on Meta, you could probably actually be quite patient on that. All right, so now let's look at the Sonder bankruptcy. What's going on over here? Marriott guests left homeless as rental company Sonder abruptly goes out of business. Wow. That's interesting. Let's take a look at this. So this here, we have Marriott guests left homeless as rental company Sonder abruptly goes out of business. Deal with hotel terminated. They treated us so poorly. This is actually really interesting because I was just reading about a Ritz-Carlton developer going bankrupt, and I pulled up the lawsuit for it. I want to see what happened with this on Marriott here, but we're seeing this happen more and more. Look at this. $2 billion Ritz-Carlton Paradise Valley developer files for bankruptcy. So I actually pulled up their lawsuit and started going through it. Here it is, the bankruptcy petition. And what I thought was really remarkable about it as I was reading through it is they basically had this construction financing that they got arranged from this group called Madison Capital LLC. And Madison Capital LLC is like, hey, we're done funding your construction project. And the Ritz-Carlton developer is like, bro, we're not done building it yet. And they're like, sorry, you're rugged. We're not paying an extra dime. And so now you've got the developer for this Ritz-Carlton facility going to the bankruptcy court going, bro, we need millions of dollars so we can keep like servicing our debt. We have $644 million of debt. This is always how it happens, dude. Debt kills you, right? Here it is. Madison claimed that their obligations had been fully funded and no funds remained to complete construction. So all of a sudden, that's the construction loan agreement. All of a sudden, this lender bankrupts basically this business who's trying to build a Ritz-Carlton. And you know what blows my mind? Is they're literally begging the court right now for $6 million. And you know what those $6 million are for? Think about this for a moment. What would you guess the $6 million are for? They're asking for $30 million of debtor in possession financing, but they want 6 advanced right away. You can see this right here. So this is where they're asking for $30 million, and right here, up to $30 million of a total commitment in a DIP loan, debtor in possession loan. They want $6 million immediately, okay? I want you to ask yourself, what do you think they want the $6 million for? This is gonna piss you off, okay? You will absolutely punch the air when you hear this, okay? They're like, we need $6 million. When I first saw they need $6 million, I'm like, great, you're gonna pay your vendors, you're gonna pay your drywallers, you get the construction project going, pay some interest money, right? Like, keep the construction going, right? Folks, the $6 million, you wanna know what it's gonna go to? The debtors anticipate that the total costs of legal assistance required within the first 7 weeks will be $6.5 million. In other words, we want you to approve us borrowing an extra $6 million just so we can pay for structuring our bankruptcy because the attorneys are taking the first $6.5 million. Like, dude, this is insane, man. Like this is what this is like so recessionary. I hate to say it, but like a Ritz-Carlton developer, $644 million in debt, and then all of a sudden they get rug pulled because one of the lenders is like, sorry bro, we're Madison Capital LLC. We don't believe in you anymore because we got nervous or private equity is tightening or whatever. We're gonna rug pull you. Then they're like, crap, now we gotta file for bankruptcy. Before we even do anything, we're gonna have to raise $6 million just to pay for attorneys. You know, this comes as, you know, now Max is so nice and donates to the live stream here and says, Kavit, check out what happened with Sonder. And this is what we opened with. Marriott guests left homeless as rental company Sonder abruptly goes out of business. I just want to be clear here. I am nervous, okay? I am not happy about where the economy is right now. I really think people are going to get absolutely wrecked with debt. I mean, I hear it already. I'm already hearing of people like, dude, I got a 6-figure margin call. And I'm like, have you not listened to like one Meet Kevin video for the last year? You know, I know it's been sexy to be on margin since Liberation Day, but dude, like, you got to pay the bill at some point. You know, set some trailing stops. Man, holy smokes, dude, I don't like debt right now at all. Hotel guests around the world were left homeless when they were evicted with only hours of notice as Marriott-backed Sonder filed for bankruptcy, creating a vacation nightmare. So just so you know, Marriott only operates like 2% of their hotels. Marriott is a brand. It is not actually a hotel operator. Founded by Mormons, great brand, but Marriott doesn't operate this stuff. Marriott is just sort of like, hey, if you follow our rules, we'll let you use our brand name and our app, Bonvoy, you know, all this kind of crap, whatever. But it's not actually a hotel operator. And I think we usually say, oh, I like Marriott hotels. You just like the brand, but they're not the ones running it. You have these individual investing companies that end up operating these businesses, and those end up being the ones that when they go bankrupt, you know, Marriott just washes their hands of it. They're like, oh, that's not our problem. You know, we didn't go bankrupt. That's just some random brand. But it's a pisser because the people who are, you know, staying at these facilities They don't know. Of course not. Most people don't know that about Marriott, which, I mean, now you know, but look at this. This was the filing from this business. Sonder Holdings to complete immediate wind down operations. Okay, so, dude, they're liquidating. Holy smokes. So the one that I just talked about with the Ritz-Carlton facility, the developer going bankrupt, they filed, I think it was chapter 13 or 11, I can't remember which one it was, but they filed a reorganization to try to buy time to kind of keep the project going. Sonder's like, peace. We're peacing out, homies. We're out. We're out. And take a look at this. Operates a global brand. Well, they don't really operate a brand. They might actually operate, in my opinion. Maybe they do. Maybe they are a brand. Design forward apartments. Or what the hell is a design forward apartment? This is the other thing. People went crazy buying apartment buildings in like South Florida and Texas and stuff. This is why I think you got to be really careful of like the Cardone types or whatever. They bought in these overbuilt areas, and now the rents are plummeting on them. And they're like, look, they're begging for liquidity to get out of these projects. And I'm like, man, this is why, we love the single family game. We just bought like 11 single families in an underbuilt area. I realize in like a challenging time, it's sort of like, how could you buy 11 single families? Well, keep in mind, we actually think we're providing housing because we buy, nasty hoarder homes and fix them up to give housing to people. We think we're helping housing. But anyway, so what is this? Today announced it will complete winding down operations immediately and expects to initiate Chapter 7 liquidation of its U.S. business. The company intends to initiate insolvency proceedings with international countries in which it operates. Sonder has faced severe financial constraints having to do with prolonged challenges in the integration of the company's systems and booking arrangements with Marriott. Whoa! They're blaming Marriott. They're like, yo, your Bonvoy app sucks, bro. And holy smokes. They're like literally trying to blame Marriott for their failure. Somebody here writes, Paradise Valley and regular Scottsdale has been areas, by the way. The new flex is in Cave Creek and North Scottsdale, writes Packet Watchdog here. Huh, interesting. So Tom from MySpace says, think he said House Hack has no debt. Correct. House Hack has no bank debt. We have a small amount of outstanding bonds for people who are investing in the current round so they can get their 5% yield through conversion. You could read about that over at househack.com. But we don't have any bond debt, any bank debt. We don't have any bank debt, which is valuable. The debt we have is a fraction of the total assets we have. If we've got, 80, 90 something-ish $million in assets, we've got what, 19, 20-ish or whatever in bonds. So it's a fraction. Take a look at this here. So Sunday, November 9th, Marriott International announced it's terminating its licensing. Oh, Marriott rug pulled on Sonder, which means all of a sudden all of any of their hope of using the Marriott brand is gone. The company is evaluating sale of the business to improve its financial condition. Bro, it always comes down to debt. Company is engaged with financial parties, but ultimately unable to execute a viable transaction for its business to obtain liquidity. That's what it is. This is always what happens, folks. This is how recessions happen. Is people are maxed out on debt, and then all of a sudden they start pointing fingers. The Ritz-Carlton guy goes, yo, it's Madison's fault. They lied and they didn't fully fund. And then Madison's like, yo, it's not our fault. Just private equity got more nervous. And then you start seeing who's swimming naked and all the cards start falling. And then all of a sudden Sonder's like, crap, we don't have enough money to properly integrate the Marriott system. And then Marriott's like, well, you guys are creating a bad experience for the customers. We're fielding the complaints. You guys are cut off. And then Sonder's like, bro, without your brand, we're screwed. And Marriott's like, that's why you shouldn't have effed around. They're like, we couldn't help it. We were so far in debt. We couldn't get the liquidity. And then Marriott goes, that's your problem, not ours. That's what happens in this kind of stuff. And then people sue each other. We are devastated to reach a point where liquidation is the only path forward. Unfortunately, our integration with Marriott International was substantially delayed due to unexpected challenges in aligning our technology framework, resulting in unanticipated costs, as well as a sharp decline in revenue arising from, yep, there it is. This is what I said. I told you it's the Bonvoy system. That's crazy. Integration or their participation with the Bonvoy reservation system. The board and I are deeply grateful for our employees. Additional information to come. Wow, dude, that's wild to me. So now this is where you're getting now the stories of people going to these hotel chains, and then all of a sudden, they're literally getting kicked out. Now that's next level, honestly. That sucks. To be in a hotel, POV, trying to maintain my composure while dragging my luggage down the street after Marriott Hotels and Sonder Hotel broke up with each other on a random Sunday and told us the GTFO of the hotel room we had booked for 3 nights in Montreal. Oh my gosh. This is so dramatic, dude. Jeez. Retired tech executive was in the middle of a 17-day stay in New York with his wife and daughter, newborn granddaughter in the Sonder Battery Park Apartments when the company abruptly went out of business. Wow. I mean, I guess if you were a tenant, not a hotel tenant, but like an actual tenant in their apartments, you probably are going to be fine for a while until somebody buys them at a discount. That's not great for apartment pricing again. Travel influencer claimed he became homeless because of the license. All right. Yep. Sad pictures, whatever. Okay. So I wonder if they have financials. They might not if they're a private company. Sonder Holdings financial filings. This is wild. No, they got an annual report. Did they go private or something? So this is, let's see if they have quarterly results. Oh, here we go. SEC filing press release, Q1 25. Why did they stop doing financials? So this is their Q1 filing. Let's just look at their balance sheet. You know why we look at the balance sheet, right, boys and girls?
Kevin is much more interested than most people, by the way, in the balance sheet.
That's right. We're going to look. Oh my lord. All right, Q1 Sonder Holdings. This is the stuff we do around here, okay? We try to figure out like what kind of canary in the coal mine was there, because just like my wife tells me, Kevin might be early, but at least he's right. All right, let's see here. So current assets. Let's see here. Total assets, a bill. Okay, so I've got cash here. Very little cash. I'm already noticing that. They've got $23 million of cash, $43 million of restricted cash, which could be set aside for construction obligations. I've got current liabilities of taxes, accrueds, payables, operating lease liabilities. Look at this. Minus, I'm going to take the deferred out. If I take the deferred out, I have $283 million, 283 mil of bills to pay, and cash available of $66 million. Q1 2025. The writing has been on the wall of this. By the way, like, you can look at this when it comes to companies. This isn't, what I did was not that hard. I cut off their deferred revenues. Mind you, these deferred revs will now become actual debt in bankruptcy that they have to pay back because they're not going to be able to fulfill that, right? But look at this. In the first quarter of 2025, they already had no money. They had imagine having $283,000 of bills on your desk and you only have $66,000. Okay? You have $4 of short-term debt for every $1 of cash you have. You're screwed, man. Absolutely screwed. Somebody here writes, I stayed at a Sonder hotel earlier this year in Cali. It was a cheaper of price, but the quality of the room was meh. Well, yeah. So that's what happens. The quality starts suffering and then people get pissed off, but they don't have money. So they probably didn't have money here to upkeep the rooms. What's their revenue? Their revenue is tanking, so that's another problem. Look at this. You've got 118 mil versus 133 last year. That's a 12% decline in revenue. So the writing was on the wall here. I mean, this is like Sears. They can't even operate the business profitably anymore. Look at this. They take the integration charge here, $1.5 million. Maybe y'all should have spent a little bit more on that. Jeez, that actually seems cheap, and they couldn't get it right. What a surprise. But anyway, look at these losses. $56 million in losses. Let's look at the statement of cash flows. Statement of cash flow. We have negative $4 million of cash flow plus plant, property, equipment. They're burning another $5-6 million of cash flow. And this was in 3 months ending in Q1. And how are they taking on? Oh, they actually did pay off a little bit of debt, $250,000. I mean, that's nothing. So, like, this is scary. You know, this is just an example where the writing was on the wall for this company to go bankrupt. Now it's going bankrupt. It's literally liquidating. At the same time, you've got this Ritz-Carlton developer going bankrupt. And then, you know, Max is bringing this up as well, but other people have brought this up to me. I've seen this in the comments like 50 times. I actually haven't addressed it yet. But the reverse mortgage explosion for seniors is exploding. Which is crazy because rates are kind of high right now, but it somewhat implies that people are out of freaking money. So you might not know what a reverse mortgage is. I'll give you a quick explanation of it. Okay, let's say you're sitting in a home that you own free and clear, or maybe you have $100,000 of debt on it, whatever, but it's worth 500 grand. You could go to a lender and say, hey, I want to borrow up to 400 grand against this property. And what I want you to do is charge me interest, but I want you to take that out of the equity that I have in the property, and I want you to give me money. So you literally squeeze equity out of the property, and you make your net worth shrink every single month. And the way you do that, usually just elderly people, I think you have to be older than 65 to do this. The way you do that is to get a steady flow of cash flow for generally the rest of your life, but it depends on how they actuate it out and you know what they end up calculating out. Could be 20 years, whatever. And so you get a stable flow of cash flow. It's kind of like an annuity based on your house equity. And you use that to live. And so if reverse mortgages are skyrocketing now, at a time when interest rates are absolutely ridiculous, they're very, very high right now, you have people that are broke going to reverse mortgages. Yeah, look at this. Cash-strapped American seniors are turning to reverse mortgages as the controversial type of loan that soared during the financial crisis, you know, as people try to make ends meet, starts skyrocketing again. Yeah. Sales of reverse mortgages have jumped this year as looming cuts to government benefits and persistent inflation have weighed on older people. Reverse mortgage borrowers, typically 62 or older, gets cash from the lender in exchange for equity in their home. Correct. 80 is a typical borrower who turns to reverse mortgages. The retiree lives in Washington State and receives $1,800 a month from government money, then took out a reverse mortgage from Finance of America 11 months ago. He was confronted with a bill for new dental crowns that he struggled to afford and ended up using a reverse mortgage to pay for it. Yeah, it's basically the needle that broke the camel's back, you know, or the straw that broke the camel's back. It's so many cuts and cuts and cuts. And that's actually why I believe that right now we're not in a soft landing environment. We're actually more like a slow bleed economy. So what I mean by that is I think the economy that we're in right now is not a plane that's, hey guys, everything's fine on the plane and it's coming in for a landing. Like if this is a plane analogy, like there's a fire at the tail, okay? Like half of the plane is on fire and it's a miracle it's still flying. So, but that's a little graphic. So I like the slow bleed analogy where it's like you're walking through the desert and you're parched and you're bleeding out by the legs. And it's kind of like, don't worry, everything's fine. It's like you got that last minute optimism, and that's what the economy looks like. In fact, there are two leaked images I want to show you. The first one is the face of this person walking through the desert. It's this. I don't need it. And then the second is Jerome Powell. And there's now leaked footage of Jerome Powell driving through the fog. And, you know, apparently these are like Russians driving through the fog. And as the saying goes, it ends exactly how you would expect it to end. So I'll just fast forward a minute here. And you've got them driving in the fog, and then they don't realize there's a turn coming up. And oh no! Oh! I guess we messed up. Now, you know, obviously you don't want to wish an injury upon anyone, but like the analogy is there, that's present. That's like, The Fed doesn't have job data, so they can't properly support us. You literally had Scott Bessent this morning going, now the economy's doing bad because of the Democrat shutdown. It's like, bro, that wasn't the straw that pushed us over the edge, man. But whatever. And if anything, many can make the argument that Trump's stubbornness, because he wanted to set up layoffs, the RIFs that he gave Vote the license to do, the reductions in force, contributed to wanting a shutdown, to weaponizing a shutdown, just somewhat backfired because people were very frustrated over this. But these are problems. And so it's not a surprise that you're seeing more and more of these bankruptcies now. Not only now Sonder, but the Ritz-Carlton bankruptcy, and this uptick in reverse mortgages. It's a scary, scary time for liquidity. And that's what we got to pay attention to, is if people think that everybody's rich and everybody has money. Because, we look at these charts that are like, oh, hey guys, we've got, all this money sitting in money markets. Like, everybody's rich. Like, imagine when all this money goes into the stock market. That's the thesis people have. But people forget that this cash is usually money that Microsoft or Nvidia has sitting around. These aren't normal everyday people, and they're using a lot of it, to buy back their own stock. But is that going to help the traditional consumer, the everyday American? Not in my opinion. I think the everyday American's getting screwed right now. That's why you're seeing these bankruptcies at Ritz-Carlton, Sonder, reverse mortgages skyrocketing. It's just a matter of time before rates actually come down and you end up having a refinance boom. And it's not going to be a refinance boom where people are refinancing their homes because they get to go invest. People are going to start refinancing their homes out of desperation. That's what I'm really worried about. Now, I think everything will end up going down if there's some kind of market correction, but that's one of the reasons why I keep looking at like the mortgage lenders, for example, because I think the mortgage lenders, well, they'll go down if there's a crash, no doubt. They will have probably the greatest earnings from desperate people flocking to mortgage lenders to get any possible money that they can out of their homes. And you're already seeing some of that with these reverse mortgages. So it's a wild time. It's a really crappy time. That's my take. Okay, good. So now we're gonna go look at some other data and see what else we've got going on. But this is like the AMD surge so far. Let's see if it's holding up. It's still holding up. It's holding strong right now, and I get it. You've got a lot of enthusiasm because AMD has also done this phenomenal recovery from where it was at like $80. It was trading for under a 1 peg for a very long period of time. And now it's still actually with these new growth forecasts still in the mid 1 range. Still pretty impressive. So, Max says, it's okay, guys. We can still get life insurance in as little as 5 minutes using Kevin's link. That's true. Don't I have a link here somewhere? Oh, yeah, that's right. I screwed these up with this slow move over here. Get life insurance. Meetkevin.com/life. I got to fix all this crap. Sorry. All right, anyway. So, these are all massive problems. And it's easy to sort of ignore it all because it's so much easier to just go, la, 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 none of this matters, none of this matters. But it matters. So, okay, let's see here. From Snowflake to Sierra, every enterprise software firm is selling the same AI agents. Right. Well, that's actually what I'm worried about, is I feel like a lot of AI companies right now are just pumping chatbots. And eventually, everyone's going to have a chatbot. Like, I just want to be clear. I have absolutely zero loyalty to these chatbots. I really care zero. And, what I do is, like, I'll put my prompt into multiple chatbots, and then I just sort of like rely on out for a chatbot output, which I still take with a grain of salt. But I look at them and I'm like, all right, well, which one do I like the best? And if one of them gets better than the other, I just dump the original one I was using. Well, I don't care, and there's no loyalty to these chatbots. Why would there be? What do I care? I don't care at all. So, my mindset is if that's all these companies, these AI firms are selling, or integrations or wrappers for chatbots, probably going to have some problems with some of the software valuations over time, which isn't great as well, because AI is really holding up the whole market right now. That's frustrating. And the canary in the coal mine of Meta. I don't think a lot of people actually look at Meta as a canary in the coal mine. I think I'm a little early on that, which is unfortunate because I do think they're the cheapest Mag 7, and I like Meta from an advertising point of view. But I do get nervous that they are, how should I put it? They're the first to roll over. And if anything, it just gives you a little warning sign for the entire eco. Oops. But anyway. All right, so then let's see here. Go back into that piece. So this is from Snowflakes to Sierra, every enterprise, no ad during bad recession. Well, that's also true. I mean, advertising, well, I mean, it depends, because some would argue that you actually end up having to advertise more in a recession because you're trying to get whatever dollars you can actually get your hands on, because then you have earnings that are already going down, and then if you don't advertise, they go down even more. So, you know, some actually make the argument that advertising can do better in a recession. Who knows? AI agents multiplying, Slack has one, Snowflake has one, Google has one. They all promise to do the same thing, forecast sales, message customers, blah, blah, blah. Everybody's got AI. Salesforce, AI agents, blah, blah, blah. You know, there was actually an interesting piece that might be worth looking at. I saw yesterday. Let's see here. Bookmarks. Yeah, here it is. It is The State of AI by McKinsey. So, could be kind of interesting to look at. McKinsey State of AI. And State of AI, except, yeah, I think we have it. All right, perfect. Let's go ahead and download this. They've got a full article on it. Oh, I could just run it on their website. Okay, so we'll go look at this in just a moment. But initially, some of the things that people are talking about regarding the State of AI report is this idea that, okay, yeah, you've got these ubiquitous agents that everybody has, but how is that a differentiated product? Like, at what point are we overdoing how much of the same investment we're making, and for what good? That's a pooper dupers. So we'll see what they have to say here in 1 sec, and I will pull that up. Get this mouse working correctly. Sony says, can't advertise with no money to do so. Well, but that's where the money comes from those money markets, right? I know, like, you have to remember that a recession is really a decline of earnings. And the people who suffer the worst in a recession are typically the consumer, you know, people like you or I. These big companies like Facebook, Apple, like, they've all been through recessions before. You know, I mean, the iPhone 1, which came out in 2007, basically launched into a recession. I remember in 2008 buying the iPhone 3G. Like, sales still happen. They still have their really good profit margins. Like, the good businesses survive. So, and you know, they keep spending. It's people who get screwed in recessions. Anyway, the State of AI in 2025, agents, innovation, and transformation. Almost all survey respondents said their organizations are using AI, and many have begun to use AI agents, but most are still in the early stages of scaling AI and capturing enterprise-level value. Okay, key findings. Let's see here. Most organizations are still in the experimenting or piloting phase. I believe that. 2/3 say organizations have not begun scaling AI yet. High curiosity in agents. 62% say their organizations are experimenting with agents. Positive leading indicators on the impact. Respondents report use case level cost and revenue benefits. Just 39% report an EBIT impact. Well, right, because layoffs really haven't even started yet. 80% of respondents say their companies set efficiency as an objective in their AI initiatives. But the companies seeing the most value from AI often set growth or innovation as additional objectives, right? Half of the AI high performers intend to use AI to transform their business, mostly redesigning workflows. Respondents vary in their expectations of AI's overall impact in the coming year. Right, only 13% right now see the impact or see AI supporting workforce size. Most people think the same or down. Okay, so reports, let's see here. Use of Gen AI, use of artificial intelligence. So that's the thing, it's like, it's almost, like at what point do you get to where it's like everybody's using it, right? Many organizations are experimenting with AI agents. Planning to use within a year, not at all. AI agents, okay, for different tasks here. Agents. AI agents have been the buzz, but usually only in one or two business functions. Looking across the entire landscape, the use of AI agents is not yet widespread. The gap highlights the contrast between the great potential that manifests in the hype cycle that is the current reality on the ground. Yikes. Let's see. When it comes to agents, it takes hard work to do it well. Yeah, I believe that. Let's see. For most organizations, AI use is in pilot phases. This is a little bit of a warning too, on top of what you're seeing with, the artificial intelligence boom. Now, don't get me wrong. Like, I don't want to be bearish AI. It's like it's going to be very hard to target, like to hit sort of a peak, if you will, and to be perfect about it. But I will say it is something that what happens once everybody's using chatbots, and then people are like, the other stuff is okay. We've got our encyclopedic work done now. The rest, meh. It's kind of what you're seeing here. I hate to say it. But okay, so let's see if I can download this document. Sign in. Okay, I'm trying to sign in. Let's see here. Let's see. All right, whatever. I'll just leave it up like this. Organizations are increasingly using AI in multiple functions. That's fine. You can see the number of functions that it's been using at. Like, people know about it, but they're not using it in everything. Smaller companies have yet to integrate AI deeply across workflows. Nearly half respondents for companies with more than $5 billion in revenue have reached scaling phase, compared to 29% with less than. Larger companies are leading scaling. Well, this makes sense. It's going to be a whole nother like big corporation versus small business thing. This is just how like the small businesses get screwed. Like a small business can't afford to go hire Palantir to, put all their crap together. So, what happens instead? Well, the big business just eats the small business for lunch, and then you're screwed as the small business. It's kind of sad. Most organizations, AI agents have not significantly affected wider EBIT. Respondents are looking at other qualitative objectives. Majority say that AI has improved innovation or customer satisfaction. Okay. Respondents most commonly report cost benefits, decrease in costs. I mean, this is fair and makes sense that costs would go down because you could do more with likely fewer people. And that's just frankly a layoff tool. So that's not a surprise. Respondents report the greatest revenue benefits from AI in marketing. Yes, I actually agree with that. That's why the marketing side is so interesting for companies like Netflix or Meta or otherwise. Some small businesses don't have a real way to collect data. Fair. So let's see. Nobody knows winning. Like, I'm going to add something so revolutionary. We're announcing 6-month loan on food. Stop. All right. Last year, we noted Gen AI was no longer a novelty. Okay, old news. EBIT progression, more efficient. Real results emerge when leaders are able to use the technology to innovate. Okay. Organizations with ambitious AI agendas see the most benefit. I agree with this. If you're like, hey, we're like all in on AI, boys. Of course you're going to see the most change. High performers. If people are just using GPT, who cares? Everybody has that. It's like, that's not differentiating anymore. Redesigning workflows, boring. High performers tend to have senior leaders who demonstrate strong ownership and commitments to AI initiatives. Fine. All right. Expectations vary on AI's effect on the workforce. Okay, I don't really care about people's opinions on this. This is all going to come down to who's going to get fired. Efforts to mitigate AI risks are becoming more common as challenges materialize. 51% of respondents from organizations say AI has had at least one negative consequence, with nearly 1/3 reporting that it came from AI inaccuracy. Well, I believe that. Second most common issue is not among the most, okay. Inaccuracy is one of 2 risks. Second most important commonly reported is not among the most commonly mitigated. What's the second risk then? Okay, well, let's see what they have here. Risks, cybersecurity, and inaccuracy. Oh, explainability and none of the above. Interesting. Okay. IP infringement, whatever. Let's see, this is a lot of yapping right now. We know that AI performers, respondents who say organizations are deriving impact tend to have more ambitious agendas than their peers. Also more likely to report more negatives. Interesting. Okay. New survey suggests its full promise still remains ahead. Most organizations are still navigating through transition. They're not yet realizing enterprise-wide financial impacts. It's more of like a catalyst to start trying to make change. That's fair. And this was an interview with what? 1,993 participants in 105 nations. 83 respondents said they work for organizations with more than $1 billion in revenues. That's pretty good. It's pretty impressive. So, yeah, all right. I mean, this is interesting. Little McKinsey kind of bear piece there on artificial intelligence. Okay. What else? Robotics data startup raises $40 million. Robotics. People are so excited about robotics. SoftBank hunts for pennies. Anthropic to build data center. Skims boost valuation. And IPO shutdown. All right, that's boring. All right. Let's see what else we have here. And is AMD still holding up? Yeah, buddy, it is. Look at that. 10%. Yeah, it's still holding true what we said in the Alpha report this morning. In case you're not just now joining, what we said in the Alpha report this morning was in order for the Qs to go green, we really need AMD to hold its pre-market gains or go up, and NVIDIA to break 196. So we can see NVIDIA below here, and we're still red on the Qs. Hopefully we can get a rebound going here, but not too optimistic at the moment. Looks like a little bit of a bottom forming though. Meta down about 2.5% on the day. Solar Edge drops another 3%. CoreWeave lost 90. It's now getting rejected by 90. Yikes. AMD though holding on nicely, gnarly. Okay, let's go see then what the journal has for us. The journal. Okay. So, we've got the Fed is increasingly torn over an interest rate cut. Yes, we know that. Kash Patel's F and Wildride as FBI director. Boring. Oh, here we go. Democrats release new Epstein emails referring to Trump. The White House says the Democrats are just cherry-picking messages. You know what just pisses me off is that politicians will literally run a campaign, and it's not to pick sides because they all do it. I feel like all politicians are they're just gonna lie to your face, and as soon as they get into office, the goal is stay in office and don't get embarrassed. And I hate to say it, but, you know, Republicans ran a campaign on transparency around the Epstein files. And they said, we're going to finally release the Epstein files. This is going to finally come out. And then it turned into, well, the Epstein files are on Pam Bondi's desk. And then she's going through the Epstein files. And then, hey, we've now released video footage of Jeffrey Epstein's jail cell. And then they're so like dumb at releasing this footage that they don't even realize that, of course, social media is going to recognize that an entire minute is missing. And then they're like, oh, well, that's because the camera's turned off during that minute. Really? Because the metadata says you actually edited these clips together in Adobe Premiere, which is a video editing software. And then as soon as you get exposed on that, you're like, on second thought, there actually are no Epstein files. And we're like, what? You said they were on your desk. Oh yeah, we were just overwhelmed. There were a lot of papers on our desk and we didn't realize there's actually nothing there. Oh, okay, all right. And then what does the Department of Justice do? Oh, by the way, we just reduced Maxwell, who's sentenced to 20 years for sex trafficking, to a minimum security prison. Oh, and by the way, we arranged this Department of Justice interview with her where we've released the full transcript, and she just happens to be really forgetful about a lot of things. Like, hey, do you know if Bill Clinton was there? I read the whole transcript. I read it. And she's like, hey, do you know if Bill Clinton's there? And she's like, nah, I can't remember. It's been so long. I'm not really sure. What about Donald Trump? Oh, no, Donald Trump was not there. I know for a fact Donald Trump was not involved at all. Do I get pillows in my prison now? It's all a performance. Like, this is all a charade. Like, they're treating us Americans like we're dumbasses. And it's really frustrating. Democrats, all right, whatever. So what do we got? The House Select Committee or whatever. New emails coming out. The new emails, a selection of thousands of documents turned over by Epstein's estate to Congress, include a 2021 exchange between Epstein and Maxwell. Years after Epstein and Trump had a falling out. Okay, this is years after they had a falling out, as well as messages with a journalist. In the 2011 email, Epstein wrote to Maxwell, I want you to realize that dog hasn't barked is Trump. That dog that hasn't barked is Trump. Some victim, presumably here, spent hours at my house with him, and he never once mentioned it. Interesting. So, yeah, victim. This suggests, that Jeffrey Epstein is sort of like recalling his discussions with, or the past with Donald Trump. And in 2011, at least, he's suggesting that Donald Trump has been with some of these likely underage sexual victims for hours. And it's just never come up before. And this could go one of two ways. This could be Epstein trying to frame Donald Trump in 2011, although this was well before Donald Trump was president. Maybe this is a way to try to set up an extraction of money from Donald Trump, or maybe it's true. We don't know. Look at these emails, by the way, from gmax at lmax.com, and then the Jeffrey Epstein email is gvacation@gmail. Interesting. And then Gmax writes, I've been thinking about that, ... ellipse. To me, this almost does feel a little framey, kind of like, hey, we need to raise some money. Hey, you know who's been really quiet about all this? Donald Trump. And then Max was like, yeah, you're right. He has been really quiet. Like, I kind of do also see these Epstein Island people as like conniving like shysters, but that doesn't necessarily mean that Trump wasn't there. Like, both could be true, right? Trump could have been there with the victim, and then Epstein and Maxwell are like, hey, we never used this card yet. Who's been really quiet? We could use this to raise some money. So both could be true. Trump could have been there with an underage person, and they could be shysters trying to use that as leverage over him, right? And then, of course, you get people in the chat like this person here. Robert goes, Epstein, you still talking about that guy? I hope you're being sarcastic because this is obviously breaking news, but that's literally the line that Donald Trump uses. So I think you could be being facetious by using Donald Trump's line. Epstein, are we still talking about that? That's old news. And it's sort of like, who cares? Because new information keeps coming out. And you suggesting that, oh, why are you still talking about that guy? Is like trying to put down Americans who are finding out more leaked information about how there is more shystering going on. And y'all kind of rug pulled us. Anyway, White House and Republicans say the redacted name was Virginia. who accused Democrats of selectively leaking emails. The unnamed victim referenced in the emails is the late Virginia, because she's dead, she killed herself, who repeatedly said Trump was not involved in any wrongdoing. So they're basically trying to fill in this idea that, oh, well, that victim was Virginia. It wasn't some other girl. It was obviously Virginia. And because she says that, you know, he couldn't have been friendlier, which is not exactly a way of saying, you know, nothing happened, but whatever, oh, this is nothing. I mean, of course, they've been trying to shove this under the rug for you know, ever since Trump got into office. You know, we're supposed to get the Epstein files on day one. Oh, well, whatever. She died by suicide, quote unquote suicide, right? Hey, we got her story the way we want it. Don't let her talk anymore. She happens to get disappeared like Epstein got disappeared. Kind of wild. It's you know, and a lot of people are like, hey, you know, the reason she published a memoir was because she was pressured by either the Trumps or Trump disciples or whatever to, just like Maxwell, basically get forced into going on record to rewrite history, essentially. Who knows? Who knows? It could all be fugazi. But the new batch of emails were released by the House Oversight Committee, and the House is returning to work. Obviously, the government shutdown is expected to end here. We're going to get a lot of data from the government now that the government is back open, especially jobs. But Democrats continue to carelessly cherry-pick documents and generate clickbait that is not grounded in facts. Well, I mean, like, what do we want released? Every single email about, you know, them paying their bills to their housekeepers, or the ones that mention Trump? I mean, to some extent, you would expect the documents to be cherry-picked. Oh, here's another one. Victim, Mar-a-Lago. Yeah, because there was talk about recruiting, you know, Epstein girls from workers who worked at Mar-a-Lago. Trump said he asked me to resign, never a member ever. Of course he knew about the girls, as he asked Maxwell to stop. I mean, this is interesting. This is in 2019. This is to a reporter. So this is when Trump was president. So it's unclear here if, you know, at this point, how the story is trying to get framed. Wolf didn't immediately respond to comment. Epstein was arrested in July. Trump said he had a falling out with him, asked him to leave from the club. Epstein saying he was never a member of the club. Wouldn't surprise me either. Let's look at the top comments on the Wall Street. These are always entertaining to look at. I love this. So most like, so the Republican argument is that explicit statements about Trump was well aware of Epstein's illegal behavior constitutes cherry picking because this is only mentioned in some of the emails and not all of them. Best they could do. Look, hundreds of pages that never mention Trump. I mean, that's kind of what I said as well. That, like, of course you're going to cherry pick because that's the juice that people want. That, like, but if that juice is bad, it's still bad. You know, it doesn't, like, make it less bad. Release the Epstein files, let the chips fall where they may, Democrat, Republican, whatever. I love that. Where were you 10 years ago? Fair. It also looks more and more like our president participated in child molestation ring, or at the best, knew of one and did nothing. Bill Clinton also took numerous trips to Epstein Isles. You know, I always think that's such a funny reply. You know, like, I mean, they're trying to rephrase what they're saying, that this person's referencing Bill Clinton when he's obviously referencing Trump. But that's also always a funny counter argument, is like, this person's a crook. Yeah, well, this person's also a crook. Okay, well, like, just because one person's a scumbag and therefore another person's a scumbag, or unrelatedly somebody else is a scumbag, does not mean they're both not wrong. Like, both can be wrong, right? Cherry picking. Why are there any cherries to pick? That's a good point. Why are there cherries to pick in the first place? Yeah. That's interesting. I always short stocks diversion incoming. This person's basically like, oh crap, we're about to get some new tariffs so we can stop talking about the Epstein files because we're gonna get some new liberation. What's the best way to stop talking about the Epstein files? Liberation, baby. Who knew we would have been able to wrap the Epstein files back to stonks? Nothing like a Wall Street Journal comment to help us do that. It's gold, baby. It's gold. Oh my gosh. Oh, did I miss an email? Let's see. There are 3. Mar-a-Lago. The dog one? Oh, let me see. Let's see if I missed an email. Epstein files. Okay. The dog, the member. Oh. Oh, interesting. Okay. Okay, so it actually also appears that I missed an email. So let's look at this email. So this is from Michael Wolf. From Michael Wolf. I think you should let him hang himself to Jeffrey Epstein. Oh my goodness. Okay. Wait. The first email is, I hear CNN planning to ask Trump tonight about his relationship with you. So the reporter is saying CNN's gonna ask Trump about his relationship with Epstein, either on air or in Scrum afterwards. If we were able to craft an answer for him, what do you think it should be? Jeffrey Epstein. Michael Wolf says, don't craft an answer for him, let him hang himself. I think you should let him hang himself. If he says he hasn't been on the plane or to the house, then that gives you valuable PR and political currency. You can hang him in a way that potentially generates a positive benefit for you. Basically, it's a way of saying like, hey, let Trump say that he's never been to your house or plane, and then you could release records showing that he actually was, and then Trump looks like a liar. That's basically what he's saying. Now, that's very interesting because, again, it shows the connivingness of this whole, like, Epstein cult. Like, you don't want anything to do with these people. But then it also helps explain why Jeffrey Epstein got disappeared. Jeez, man, this is freaky crap, man. Oh, yeah, dude. Politics is so dirty. Of course, it is possible that when asked, he'll say Jeffrey Epstein is a great guy and has gotten a raw deal and is a victim of political correctness, which is to be outlawed in the Trump regime. Dude, this Michael Wolf is on it. In 2015, 10 years ago, you know, he's just taken advantage of by the radical Democrats. Dude, this is crazy. This is just, oh my gosh. It's never ending, you know, this kind of stuff, and it's like, it's a head shaker. That's all it ends up being. It's a head shaker. We look at this as like normal, everyday Americans trying to make a buck, trying to get up, get ahead every single day, trying to invest. Anytime y'all, thank you, by the way, to those of you who buy the Alpha Report and join it, we look and we go, hey, how can we funnel this back into more investments, into House Hack, the real estate startup, just help the whole community, the ecosystem, better app, whatever. And boy, like we're just normal people trying to get ahead. And then this is the kind of stuff that's going on in the world with the suits and the lies and the theft and the murder. I mean, it's even sus how Sam Altman answers murder questions when he gets asked about murder with Tucker Carlson. It's like, oh yeah, your employee just wanted to kill themselves, huh? Who was bagging on your product at a really sensitive time while y'all are fundraising, huh? I don't know. Maybe I should go on record and say I would never kill myself. I mean, I'm not involved in that world at all, but boy, it's scary because we just comment on it looking in from the outside, and it's scary because, sometimes these conspiracy theories just end up having a whole lot more truth to them than you want to let on. And I've never been much of a conspiracy theorist, but the more you just listen and read some of this stuff, the more it's like, dude, we are so in the dark about the shenanigans these people do, and it's always about money and political power and scamming. It's just sad. All right, so what else we got going on here? Let's go see if AM Dizzle is still holding up. Okay. Really makes you question if these elite group really exists to planet. Or yeah, no kidding, it really does. All right, so yeah, Qs are really dumping. Wow, dude. I had a course member ask me this morning, Kevin, if the Qs go down, what level do you think we go to? And I said 617. Look at that. We just had a bounce at 617.81. Wow. Fear is a factor again. I really think this Meta thing is a canary because its valuation and its earnings are fantastic. Somebody says, you do not have a high IQ if you're not a conspiracy theorist. Well, I mean, I always thought my IQ was pretty good at room temperature levels. I don't, you know, I've always been impressed. Like, I keep my room temperature at usually like 67 in here. And I always thought that was a good IQ. All right, so let's see here. All right, so Bitcoin's also coming off of its run right now. You have Bitcoin coming down nicely off of 105, now down, what are we at, 1014? And then I do want to pull the Meta investor relations piece. So if I pull Meta and we grab their last, let's grab their financials. Earnings release, 10Q, and it has CoreWeave released their 10Q? Nope. No CoreWeave up yet. Okay. Let's go with Meta, 10Q, 1112. It's already 1112, isn't it? Somebody's like 67 is cold. It is. It is cold in here. And I do that because there's so many lights in my face that it gets very, very hot. Yeah. And then you start sweating. And the last thing you want is to look like you're sweating on a live stream, because that's when people are like, dude, what's wrong? Like, no, you don't look bad if you're cold on a video, but you look like crap if you're sweating on a video. So, like, it's better to lean towards the cold than it is to lean towards hot when you're videoing. So the finance charge here, the income tax charge here is really what obviously tanked Meta's net. But let's just ignore that for a moment and look at their income from operations. It's actually very, very good. I mean, look at this income from operations, 20,535 divided by 17,350. I mean, you have an increase of 18.3% year over year, which is phenomenal. You can see their R&D is really popping off, though, which this creates those metaverse-style concerns, right? 35% over here, which isn't great. And then, obviously, if I go 51.2 divided by 40.5, I'm up 26% on top-line revenue, which means we're increasing our R&D more so. But look at their margins, 9206 divided by 7375. Their margins are up, no, their cost is up about 24.8%. That's actually a cost improvement, though, about 1%, 1.2% leverage over there on reducing their costs, which is great. Their G&A had a pop off over here, which would be interesting to see exactly what's going on over here on G&A. But the point is, you know, this is a company with a lot of money, and they're being very smart to keep this, you know, recent data center. The $30 billion off-balance sheet data center is absolutely brilliant. We broke it down already because they can cancel the lease commitment in tranches, and they're not liable for the bag, which is really smart for them. So good on them. You know, current expenses and current liabilities, I've got about $37 billion in expenses, which roughly matches what they have in marketables. I mean, I've got $44 billion in cash, which is actually really impressive, plus another 17 bill coming in. That's, you know, what is that? 44 plus 17, that's 61 billion. And bills of, their current bills to pay are 37 bill, total bills to pay. They do have long-term debt of 28 plus 12 plus income taxes. Well, I guess they still haven't paid down all their income taxes. But 11.7 plus 12.1 plus 28.8. Still got 52 of long-term, right? Still 52 bill long-term. So, I mean, they can't pay off all of their debts. But it makes sense why they're trying to keep some of it off balance sheet. But wow, that's quite interesting. Oh boy, oh boy, oh boy, oh boy, oh boy. Okay, so talked Epstein, AMD we talked about the bankruptcies. Now, let's see what else is going on out there. Okay, what is this? An Accenture ad? Okay, Epstein alleged, Trump knew of his conduct, GOP lawmakers, we already covered that. Yo, get out of my face here. GOP lawmakers released thousands of files related to Epstein? Oh, really? Are these the non-cherry-picked ones? 23,000 pages. Oh, wow, okay. So the Republicans are like, look at all the ones that don't have cherries in it. That's interesting. In one exchange, Jeffrey Epstein apparently pitched on a transaction related to his Boeing 727 by somebody who said they previously worked for Trump. Apparent letter of recommendation was attached. Carolyn Levitt said that Trump claimed he kicked Jeffrey Epstein out of the club due to being a creep. Right. Because we can believe the minister of propaganda. Democrats selectively leaked emails to create a fake smear. Well, this is interesting. The Republican response. Hours after they released 20,000. Wow. I mean, yeah. That'll be interesting. We'll see what else is in there. So finally getting some more emails. That's actually very interesting. All right, so Republicans are freaking out about these 3 new emails that came out regarding Trump and Epstein because the 3 emails look bad. And Republicans are like, look, you're cherry picking data. And of course, other people are like, well, why are there cherries in the first place? If there's nothing there, then there wouldn't be a cherry in a single email. So in response, Republicans are now actually releasing more of the Epstein files, but the ones that they're picking. So Democrats picked 3 with cherries in it, which we go through. And then Republicans are like, oh yeah? Well, here are 20,000 more documents that don't have anything sus in it, presumably. Apparently 23,000 pages in those 23 documents are now being released by Republicans. Obviously, it'll take some time to go through. But a lot of people say this is just a distraction because the Republicans are actually embarrassed by these new emails that are coming out. And of course, Carolyn Levitt, who's essentially the minister of propaganda for Donald Trump, says that Jeffrey Epstein was kicked out by Trump. Trump knew he was a creep. But the emails, a little sus. Okay, so, well, this is interesting. I mean, this keeps evolving, huh? Well, it's not evolving as the stock market today. The market is like devolving. Somebody says, what's going on with Lyft? I don't know. What's going on with Lyft? Is it getting a lift or is it getting dumped? I would like to know. Well, let's find out. Lyft. Lyft. Oh, Lyft's doing actually quite well. I remember I made a video about Lyft when it was, I mean, what's its market cap right now? 10 billion. Yeah, it was like $6 billion. I'm like, you know, Tesla should really buy Lyft. And looks like Lyft's finally picking up a little bit. But I still think that would be great because then Tesla would get access to all these customers. You have to remember, the customers, a lot of customers aren't like, you know, big Tesla fans necessarily. They just want to ride. That's what they care about. They want to ride. They want to get from point A to point B in reasonable safety and comfort. And this is quite interesting. So... Okay, let's see here. Okay. That's that. And then... Okay, that's good. So now, let's see what else. It's 9:04. California time. We have stock market's somewhat stable. How are yields doing right now? Somebody said, Tom from MySpace says, how do I get 3x leverage on house hack? I don't know, man. Oh, you got to figure out where to get your own debt. I'm not the biggest fan of debt. You know me. Oh, wow, look at that. 10-year yield is down 5.2. And gold, dude, gold's taking off again. 4,200. Wow. That's wild. I mean, I wonder if gold can actually make it to 5,000. Elon Musk secretly spelled out MOAS on Sentinel Sun post. Oh gosh, let me see. Dude, he will do anything to pump the stock. Like, he loves getting retail to pump. Obviously, because that's how he makes his money, you know? Makes more money on pumping the stock. Sentient... I saw the Sentient Sun post yesterday too, but Sentient Sun, Elon. Time. Oh. MOASS. Time to make the mind of a sentient sun. See, I read this and I'm like, what the F are you even talking about? Like, what are you saying? Made no sense to me at all. But now people are saying this was supposed to be the MOAS acronym, which is mother of all short squeezes. Interesting. Nobody else is really touching on that here. Wow. Okay. That's actually quite interesting. That's very interesting. I'm hopeful, but I don't really know if I believe it. Okay.
But the email.
Oops.
Democrats release new.
Yeah, there it is. Okay, good. So that's good. All right, now let's. Okay, so let's see what else we have. Let's go Politico. I think probably all of the political pages are probably going to be on Epstein right now. Tariffs are on trial, but U.S. talks move full steam ahead. We've got Besant says cuts on tariffs are coming. We talked about the stimmy this morning. Epstein says Trump knew about the girls. We saw that. You know what was also interesting was the Newsom visit to the climate summit, which Donald Trump didn't go to. So they invited Newsom instead. I thought that was really interesting and kind of a smart move for Newsom. And I love bagging on that guy, but that was kind of brilliant. All right, let's go see what clips we can get here of any kind of entertaining vids. So let's see here. Somebody here says 5 things you should never tell anyone. And this is some, let's see here. Let's see what he says.
That I think you should never share with anyone. And I learned a couple of these the hard way, and I don't want you to go through that pain. So let's get a power.
5 things you should never tell anyone.
Choose to share this with them. And your job.
Your salary and savings. Yeah, I mean, there's this whole principle about the blue jeans millionaire. So, all right, let me see. Does he just put them all up on screen? I think he does. Yeah, he does. Okay, yeah. All right, well, let's take a look here. So 5 things you should never tell anyone. Number 1, this guy's video is doing really well. And he's got this whole like, hey, I'm a boomer. I'm just trying to give you life advice. And that's no offense to boomers. It's just like, this is fair. I like it. I respect it when people share these life advice things. Something that I learned, pretty early on was there's a huge benefit to the stealth wealth and under the radar kind of wealth. because you just don't attract the negative attention that comes from envy or legal battles or, whatever, criticism. There's something nice about having money, but then just stealth wealthing it, being really quiet and modest about it. I think there's a big value to that. And I think this is where sort of, the noob approach is, hey, look, I got a shiny new car. I've got all this fancy clothing. Whereas the pro approach is, nah, man, blue jeans, baby, blue jeans millionaire. So I love that aspect, and I see that as like a really good noob versus pro tip. So I think that's actually a great one by him. Let me listen to it for a moment.
Planning attorney needs to know that. And that's why I say it's on a need-to-know basis. The next one that can bite you, and unfortunately, you're giving the other person a lot of power if you choose to share this with them. And that is if you're thinking of quitting your job or retiring from your job.
Yeah, why would you ever say that? That's like the most newbie thing to say, because if you say it in confidence to a coworker, they could use that to weaponize against you and sort of let slip, oh, well, why would you promote them? They're thinking about retiring. You just screw yourself. That's a noob move. Like, you want to be there forever is the thesis. Even though people know, like, it's very rare to be somewhere forever. The Wall Street Journal just ran a piece on this. I can't remember what it was, but it was something to the effect of like, yeah, there it is. Why high-powered people are working in their 80s. Was it this one? But there was basically an argument that they were making about, I don't think it was this one, but they had a whole piece on how there were these workers they interviewed from Target that were still working there, and they've been there through generations. There it is. What America's longest tenured employees say about work then and now. And they've got like this Tiffany jewelry cutter and this, Target employee. And these are people who have been working at these companies since the 70s. This is really rare. It's so rare that they're profiling these people and had them on the front page of the Wall Street Journal for a while. This was cool, Target in the 70s. Because it's so rare for people to stay at jobs, because today there's been just such a consistency of you take your salary and then you try to go get a different job with either better stock comp or a bigger salary or whatever. There's very little loyalty anymore today. I actually think there's a big benefit to being loyal to a company and growing with a company because, first of all, you keep your seniority, but second of all, you can really grow with something you're committed to and truly become that 10,000 hour expert and proficient at something. But it's super, super rare now, so everybody's kind of looking to step on somebody else. So that's probably pretty good advice here. So I like that. I would argue that is pro advice. And so thank you for this guy. Let's see his take on it briefly.
And why take that risk? Why give a colleague at work that power over you?
Yeah, exactly. Why give a colleague that? Exactly. You could see by the viewership of the video here, people just literally looked for when the text popped up on screen, which is what I'm doing. Power of attorney. What does he say about this?
People give powers of attorney to other folks, typically family members, and trusting that that person's going to keep their best interest in mind.
It's never about the best interest. As a real estate broker, I hate to say it, but I've seen this so many times where family members will get a power of attorney from like an older individual. I feel like this is like catered towards an older audience. But, a noob is like, I can't deal with the stress of selling my house. I'll just give my son Jimmy a power of attorney and let him do everything. Jimmy's like, I just want my bag as soon as freaking possible. So this isn't about, necessarily doing what's best for mommy here. It's about getting the bag as soon as possible. I hate to say it. I have a feeling that's the direction he's going with this. But yeah, man, at most you usually want to see limited POAs.
And there may be a time that you need a power of attorney, which allows somebody else to
we know what it does. It lets people sign legal paperwork
to make sure, have your attorney work with you, not somebody else. Even if a child says, hey mom, hey dad, I need a power of attorney for this reason, and you can talk to my attorney. No. You want to talk to your attorney, somebody.
Yeah, I think that's actually fair advice. Pro advice by this guy. What do you think of your boss? People you dislike, hate. Yeah, you generally never win criticizing other people. And it's so challenging because on YouTube, there's so much that comes from like in the social media world, like the drama of like criticizing other ideas. Like I remember I made it was actually a great video and very complimentary towards Graham Stephan. It was the first video that I really made. I had 12 subscribers on the YouTube channel, and the title was "What Graham Stephan Isn't Telling You," and people thought I was like dumping on him. And then they watched the video, they're like, "Oh, that's actually really good advice." It was about real estate, like FHA loans, or some opportunities that you could do by buying fixer-uppers. Wow, I've been talking about wedge deals since 2017, even longer off YouTube, right? But it's interesting because a lot of people watch that and are like, oh, this is great advice. People bought houses back in 2017 when it was still affordable to do it, and people made a lot of money off that video, and I'm very grateful for that. I'm very happy for people. But typically, as soon as you start dumping on somebody else, like you criticize a business model or an idea, okay, start dumping on other people, almost always comes back to bite you. This guy's so right about this.
That you dislike or maybe even hate, right? You have a deep dislike for those people. There's a really small circle of folks that need to know that.
Yeah,
and
your wife.
Regarding your relationship with your boss, if you're married again, confiding in your spouse, that's perfectly fine. But
yes, dude, this is awesome. People are gonna think I watched his video first. This is just like raw reaction, like, yeah, of course you tell your spouse, but I mean that's obvious. No, he's right about this. I like this. I think Lauren's got the same guitar, by the way. I like this guy.
And cause really stressful situations, and even in some situations cause somebody to have to change jobs, because once something like that leaks out to your boss, and your boss obviously has a lot.
It always comes back. As just like noob versus pro here. If you're newer in the corporate workforce and you're like, as an example, hey man, I feel like I'm not getting paid enough or whatever, it always trickles back up. And as soon as it does, you come across as an entitled brat, and then guess what? You end up getting fired. It always works out that way. It's crazy how small the world is, and how like everybody knows everyone, it seems.
Control, you want.
So great point out here. What about this? Let's see here. Bonus number 5. But how is it bonus if you were not on number 5 yet?
If you have a serious mental health condition, be really careful who you share that with. Now, I feel like that's obvious that you don't want to say that. But these days, you have to be really careful, because there is what I call faux transparency going on, and you have to be really, really cautious about this, okay? So here's how this works. I see this a lot more with women than with guys, but women will very openly talk about, taking, Xannies, or, whether it's anti-anxiety pills or like Zoloft or depression medication or whatever. And a lot of that discussion, it starts because there are influencers on TikTok who are like, oh, I'm coming out as having this mental health issue. I signed up for HIMSS to sign up for, mental health medication or whatever. I got it over a virtual appointment. I didn't have to go into an office. They're basically willing to prescribe this crap to anyone, whether you need it or not. I hate to say it. But a lot of those partnerships or a lot of those posts are actually just paid ads. So companies like HIMSS, really has little to do with the stock, that's a whole different issue, but companies like HIMSS are paying a lot of money for influencers to promote these paid sponsorship posts and these ads. And then what happens is they're going, oh, here's my coming out journey about mental health, but they're not really properly disclosing that they're actually being paid for these mental health promotions about being transparent. And then all of a sudden you get people that think, oh, it's normal to go talk about mental health, and I'll just tell everybody about my problems. Well, the reality is people are trying to match these influencers. Here, I found it. People are trying, here, Lexapro. I've been on Lexapro for 9 months. My medication quieted the noise that I suffered for years, right? And then it turns out like these are just product placements, like hashtags, girl take your meds, Lexapro, Lexaho, Zoloft gang, antidepressants, SSRI, girl take your crazy pills, pop them like Skittles. And these people are getting paid by these companies to promote this crap. They don't make that obvious. People feel like it's okay to be transparent about their mental health illnesses.
And then that ends up getting weaponized against them because people think they're crazy and they don't end up getting a job promotion or whatever. And then that just like reiterates the downward spiral of depression. So, dude, this guy's good. You know, who's this guy? This is Azul. Azul. We like you, Azul.
Challenges, for instance, when COVID first started, it created for me the first time in my life some anxiety.
Oh, dude, everybody's got anxiety now because of freaking social media. I hate to say it, man. You go to the gym, everybody's on their phones scrolling on Instagram or whatever. Anxiety. Like, if you want to reduce your anxiety, less scrolling. I like watching videos. You know, I'll put on like podcasts in the background, but usually I don't actually do a lot of YouTube myself because I try to have a different perspective than everybody else. So I purposely stay away from YouTube, and then I'll watch like, you know, NPR or, you know, Wall Street Journal, kind of longer form news style podcasts. You know, I try to get the balance of the left and the right in there. The Economist is a great one that I like listening to as well. And you can play their audio in the app, hashtag not sponsored. But yeah, this guy's, I mean, like, yeah, he's right. So I think the noobs, you know, don't even realize they have anxiety. Where the pros start realizing, man, social media and scrolling is making me feel bad about myself all the time. Because you're like, I hate to say it. Dude, I literally got an email from somebody yesterday. I'm sorry I'm pointing this person's out. But I sent a daily wealth email out yesterday. And yesterday's message was about Charlie Munger and Warren Buffett. And the noobs, you know, don't even recognize that, like, it's okay to make mistakes. You're not always going to be perfect. If you pick a portfolio of 10 stocks, not everyone is going to be a banger. But the problem is the noobs don't realize that when they go on X and then they see post after post that's like, oh my gosh, I made so much money on this stock. And then somebody else, I made so much money on this stock. Oh my gosh, I made so much money on this stock. People aren't posting their losses. So it makes it feel like everybody around you is winning and then you're not because you're a normal human. And you're getting selectively shown all this really exciting stuff, and it makes you feel like a loser. So somebody sent me an email reply to my daily wealth on this Charlie Munger Warren Buffett thing yesterday, and they're like, man, I'm so depressed. You know, my portfolio went from like $1.6 million to 1.5. And like, I was so tempted to reply and be like, dude, shut the F up. Like, first of all, you're in a great place. Second of all, stop being a little pans, right? Third of all, it's a freaking number, and you're gonna make a difference. And like, read the email again, bro, because I think you missed it. If you want the daily wealth, you can get it for free. You type into your browser, meetkevin.com/data, and then at the bottom, there's a little email sign-up thing for it. But anyway, it's crazy. So I like this guy. Like, to me, that email was the example of a noob, and like the pro is like, nah, man, I'm gonna look around and be grateful for what I have. The children that I have, the job that I have. You know, that doesn't mean you don't have challenges. That doesn't mean there aren't bills to pay or frustrations. But don't make it worse by being relative. What is this?
Child, but there are password managers, and this is really something, a journey that I've been on over the last 2 years, is to get much better about my passwords. And I now use commercially available password software. And I really like it. And if I need to share a password with somebody, I can use this software, and they have to have an account with that same company.
Right, and get like 10 passwords or whatever. Yeah, I mean, his bonus there is never share passwords. I mean, look, you should really have 2FA on everything. I think that in addition to having a password manager, if you have 2FA on, even if somebody knows your password, they still need your Google Authenticator code or your, I mean, worst case text message code. I don't really like those because they're so easy to get SIM swapped these days. A tip, like the real pros who don't want to get SIM swapped, they have a second phone number. So pro tip here, like noobs are gonna use their regular phone number that everybody knows. The pro goes in and says, no, I'm gonna have a second phone number that I'll get like a Helium or a Mint phone number that costs me, you know, a few bucks a month, maybe 15 bucks a month at most. Second phone number on your same phone, so you don't need a second phone. And then you could switch between the two. I mean, I've got 4 phone numbers, but I've got a second phone number here. And so I could just switch over to it. Both of the text messages come in, and it's great, but I don't give anybody the second phone number. So it's like a second secret phone number that I use for my 2FA that nobody publicly has. And it's great, because then it's like if my main number gets SIM swapped, people are going to be really disappointed because it's like, well, damn, you know, nothing's on this phone number. So that's a pro tip. Anyway, I like this. This was actually a really good exercise. Maybe we should do more of that. 5 things you should never tell anybody. This guy's good. I liked it. All right, what do we got over here at CNBC?
Right, to just the AI trade in general, tech companies in general. The entire premise of this run-up and the defense that has been made for a lot of these companies and all the spending that they're doing is that they had these enormous cash positions. They have now drained a lot of those cash positions. And again, I'm speaking with a broad brush. I know that there are idiosyncrasies.
Well, they haven't
all
really
these companies.
drained them. They haven't
come
drained
down.
them.
They've come down
A little
because
bit.
they've spent.
The
Now,
hyperscalers are still sitting on mountains of
They're
money.
sitting on it, but
let's
not
not act
everybody.
like they spent it all the way down.
Agreed.
All the hyperscalers.
Sitting on it, yes. But then why do they need debt if they're sitting on the cash?
This is cheap
Let's
enough for them.
go.
Okay, so moving forward,
She's right.
If there is, this is not even necessarily just a warning sign that there's more debt. If we start having more debt in the system, in these stocks, in these particular names that the entire economy is looking at, that the entire stock market is looking at, then we have to pay more attention going forward. Scott, to your point, this isn't a today problem. Going forward on credit spreads, on CDX, on everything that the debt market will tell us about when and where the stress may begin.
Spreads have widened by like
have,
80 basis points.
But because of the regional bank stress, not because of this.
No. The hyperscaler spreads have widened by about 80 basis points. If you look at the chart, it tells the story. I mean, yes, they're issuing a lot of debt, but they also have the best balance sheets around. They're the most resilient companies around, which is why people look at even the widening, which is small relative to historical standards, and say, it's not the big deal that people would like to make it out to be.
Let's put it in context.
It's not.
Carrie
It's
first.
not.
Carrie
Well,
first.
we on Oracle, we bought it before September 9th, had the big run up, now it's down 31%. To say that it's the poster child for this question about when is too much debt going to really hit the stocks hard, it's hit this stock because Oracle was new to the party, right? New as a member of this elite group. They have a huge backlog in sales. And if that comes through to them, they're going to be just fine. The big issue, in our opinion, is whether the economy is holding up enough so that there's business for everybody to go around. If the employment numbers continue to weaken, and we don't know what to believe or not to believe about the labor market because we don't have any numbers, we're going to start to get those numbers again. And that, to me, is the issue with whether the debt on these companies is totally fine or whether we have a problem.
I'm not saying they're not going to be. I'm not saying they're not going to be fine. What I'm saying is, first of all, if you're a CFO right now from a hyperscaler, I don't think you're using debt. I think you're using the cash flow because you learned your lesson with Oracle.
Not really, dude. Cash flow is like going negative here. I have a dispute regarding that.
The story that's been told for the better part of the last 2 years that you don't have to worry about this because this is
the hyperscalers
all
are
cash
tapping the
from
debt
innovation.
Market, what do you mean?
It's
not at Oracle.
Not to the degree that Oracle.
No. But I mean, we're still talking about tens of billions of dollars worth of paper. We are.
Oracle was by far the leading issuer in terms of overall supply.
Yeah, but you're saying, well, CFOs of hyperscalers are using the cash. I mean, they're raising debt.
I think
I could give you a chart.
And I would think from after seeing the effect on Oracle moving forward, I think you'd be hesitant as a CFO to continue.
I think you'd be irresponsible CFO not to take out debt if you're a Meta because your cost
Meta's fine.
Your cost of debt is around 2%. Their bonds go up to 5% or so, and versus the cost of equity to use, it's much higher. So you're supposed to take out debt when you're a CFO at a cash-flowing company.
All right, coming up, we do our call of the day. A top firm says buy.
This debate is really interesting because, dude, the CNBC bros are now bitching about, let's use more debt to finance this. Wait a minute here. Like, are we all of a sudden getting a little too crass here with all right, boys, we need to keep the bubble going. Let's make sure we encourage them all to take on more debt. That's fascinating, and you're actually getting some like counter argument here, where people are like, oh, wait a minute, maybe the cash flows aren't as good as we thought. Maybe, just maybe, this is bad. When CNBC started to say that, I don't know, that almost feels a little bit like a canary too, huh? That's wild to me. Let's see what's going on here. Okay, so let me hit the doomers for a moment. Come on. There we go. Okay, that's not what I wanted. There we go. Oh, bummer. Another ad. All right, that's fine. So, let's see what else is going on here. So, we have. Okay, Bitcoin at 1015. Seems like the Michael Saylor push isn't holding. I think the Michael Saylor push really pushed through to 105, but that's it. Now look at my employer's earnings. PAL? Who's PAL? PAL stock? What is this? Proficient Auto Logistics? Bro, I don't know that we could do that right now. $241 million? Dude, bro, it's tiny. Third quarter result. Be careful with it. Like the thing that's fun about the smaller companies is they can moon. You know, that's always what's so fun about them, is the moon potential is like massive, because the small cap plays, like if you get on social media, people talking about them, they move. Because there's just so little liquidity in them. That's how Open Door moved off of 80 cents. They didn't move because their business got fundamentally better. If anything, their business has been worsening. I mean, we should go look at some of their latest earnings. That'd actually be kind of interesting. But yeah, I mean, like small cap companies can move very, very fast. Let me see here. Okay. So you know, here's a company that's operating at a loss. We've got, what is that? $101,000 loss. So is that right? $1.8 million of stock-based comp, bro, in 3 months? Holy smokes. No wonder you want to know about it. Everybody's getting stock-based comp. Restructuring charge of 1.9 mil. Balance sheet. Here's the balance sheet. I've got 14 million in cash, and then current liabilities. Holy smokes! Look at the bills to pay. That's $40 million of bills to pay, plus the lease. So I got like $42 million of bills to pay. They do have receivables, so they do have accounts receivable, which is nice, but they don't have. I mean, they need that money to come through. Operating revenue, 114 mil. Purchase transportation, depreciation, total operating expenses, 114 mil. I mean, they have no margin. Once you take out the whole business, they've been losing money for a while here, and they're operating basically at no margin. It's unfortunate. I mean, I don't really know anything about it. What is this? Slower seasonal period. Trucking. Man, trucking's just been in a recession. Who knows? You know, sometimes these things, they just moon out of nowhere. Anyway, all right, so what else here? Let's look at the Open Investor Relations page. So if I go to Open's last page, financials, SEC filings, go to quarterly, November 6th. Let's download this. Open Q10Q. Okay. Let's see what's inside. Open Door. So here's Open Door. Their asset base right now is, I've got almost 1.5 billion in cash and cash equivalents. Almost 1.5 bill. That's pretty good. Real estate inventory of 1 bill. It's pretty good too. Then we have debts. Current bills of 914 mil. That's good. And then I have non-recourse asset-backed debt, other debt of 9.6, or 966 mil of other debt. So, you know, they still, even after all their debt, they have extra cash. That's good. And what do we have over here? Yeah, still losing money, of course. The business model sucks. So net loss of $90 million. Operating expenses 134. Yeah, no surprise. Gross profit 66 million. So, like, their margin on the houses that they flip is 7.2%. 7.2% gross margin. How do you run a business with a 7.2% gross margin? You know, and then sure enough, and they just cut their sales and marketing a lot. Look at that year-over-year decline. 66 divided by 96. 31% decline in marketing. That could show up in revenue risk later, right? That's not great. They also cut technology by 36% decline in tech. I mean, to me, this seems like, you know, people are trying to squeeze out one last bag over here. Wow. All right, when we go over here.
House Speaker Mike Johnson is going to have to come up with a plan. But ultimately, those are sort of the two twin deadlines that we're watching, end of the year and then January 30th, because these other key agencies, including national security and defense, things that can often be contentious, are going to come up. And Scarlett, we know that the Senate is looking at much higher spending levels than the House and those members of the Freedom Caucus ultimately want to see.
Yeah, good point. What's been interesting about all of this is how President Trump has largely played a hands-off role in negotiations. But we do know that he does have some plans tonight, which reportedly include hosting a dinner of Wall Street elites.
Right, exactly. So on the public schedule, it just says that he's going to have a private dinner at 7:30 p.m. Eastern. But a person familiar tells us here at Bloomberg News that executives like Jamie Dimon, David Solomon, and Larry Fink will all be in attendance. The overarching Washington context I can give you is that we're seeing a refocusing from this White House back onto the economy after Republicans saw a slew of losses last week centered on affordability, and polls, including one conducted for Bloomberg News by the Harris poll, show that a majority of Americans are upset about the direction that the economy is headed. Now, of course, we could speculate. There's surely a lot of different topics that they could discuss. We know tariffs could likely come up, as JP Morgan has pledged $1.5 trillion in investments over the next decade when it comes to investing in critical sectors that the Trump administration wants to see. I also have my eye on, after this report from the Wall Street Journal earlier today, that we could see an executive order curbing the power of proxy firms when it comes to decisions. Also, whether or not these banks are lobbying the administration for a role in any sort of potential initial public offerings for Freddie Mac or Fannie Mae. So there's really a lot on the table tonight that could be discussed, Scarlett.
Sounds like it. All right, Tyler Kendall, thank you so much. You'll be on top of all of that. Tyler Kendall, our Bloomberg Washington correspondent. Coming up next on Bloomberg Markets, in just a few moments, National Economic Council Director Kevin Hassett will be sitting down with David Rubenstein, and we will bring you that conversation when it begins.
Oh, that could end up bringing up some news. That'll be interesting. Okay. Let's see here. All right, so we talked about this, talked about this. All right, what else do we have out there? Let's go back to, okay, Bitcoin's recovering a little bit, 101.8 right now. Qs are coming up a little bit. A little bit of a push on the Qs. Meta's recovering. Okay, everything's slowly recovering a little bit. Nvidia's trying to push, AMD's trying to hold. That's good. Somebody says 2026 is going to be a year to remember. Yeah, I think you're right. Let's see here. Toyota doubles down with hybrids with $14 billion battery push. New North Carolina plant aimed at selling more hybrids. I don't blame that. You know, I hate the range anxiety, and we have all Teslas basically. It's wild. Inside Microsoft's new AI data superfactory. Oh. Wait a sec, what was that? American ship restriction AI Cold War. Oh, okay. What is the Cold War argument? Oh, with China. Oh, okay. What do we have here? Oh, and there was also an IAEA report this morning. Let me scroll to that really quickly. IAEA. Oh, here we go. Okay, Iran. Okay, interesting. This is actually somewhat good news. Let's write some of this down. So, because I've been writing about Iran here, and I want to write down this Iran. Okay, so the news that came through this morning was that IAEA still doesn't have access to Iran's highly enriched uranium stockpile. They are very concerned. Iran has begun to facilitate agency access to facilities not affected by attacks. Okay, well, that's some good news. Okay, that's good. Reestablishment of current inventories needs to be... Oh my gosh. How did I screw this up so badly? And that never works. Facilitate agency access to facilities. There we go. Facilities not affected by attacks. Okay, perfect. Then we have Iran's stock of uranium enriched up to 20% is still estimated to be 184 kilos. Theoretically enough to produce a nuclear bomb. Wow. 20% enriched uranium at 125 kg. Believe Iran has 184.1 kg is enough to produce a nuclear bomb if enriched further. Wow. Okay. 42 kilos of 60% enriched uranium is enough to produce a bomb. And then they think Iran may have as much as 9,874.9 kilograms of enriched uranium, 9,800 kilograms. 2 quarterly reports are busting for additional sanction. Yeah. All right. That's interesting. U.S. Leader Scalise, House to vote on shutdown bill 7 p.m. Wednesday. Okay. All right. Separately shut down. House to vote at 7. This goes in the Meet Kevin app, by the way. Oh, what's this?
What happened is that in the Biden administration, it got very high, averaged 5%, was still in the high 3s when we came in, and now, like, if you look at the latest CPI, it surprised 48 of Bloomberg's people who forecast these things on the downside. If you adjust for a refinery that shut down, then you're kind of looking in the 0.2 range. And so I think that inflation isn't all the way to where you want it to be, but that the momentum is pretty directional. And so I think that if you add to that the basic idea that the policies that we're pursuing right now are increasing supply, their supply side policies, then you should expect that we could have growth like we're seeing without picking up Phillips curve effects in inflation.
So you may have noticed the president was calling on the chairman of the Federal Reserve to lower interest rates. And
really? He did?
Yes, he did.
Oh.
And the interest rates have been lowered. The last time the Federal Reserve FOMC committee met, they lowered by 25 basis points. There's a wide expectation that the Federal Reserve Board might lower again in December Do you have a view on whether, if the Fed does lower it, should be 25 basis points or 50 basis points as the president, or do you have a view on what might be better for the economy?
Well, I first want to say that I have high regard for Jay Powell. I've known him for a long time, have had economic conversations with him many times during the last administration and this time too. And, I think at times he and I have had policy disagreements, but that's where it is. And I think that an example of a policy disagreement that Jay and I might have is that, I sort of agreed with the previous two meetings that it was the right time to cut rates. And then after the last meeting, the sort of two things that happened that surprised me looking at the macroeconomy is that we had the shutdown that happened and then was longer than expected, which is a negative for GDP. And then we had an inflation report, which was much better than everybody expected. Why 48 people at Bloomberg missed it on the high side. And so I'm thinking, if I'm sitting at the FOMC thinking about how that affects my decision at the next meeting, then I'd say I'm more likely to move, because we got like two things that say, oh, well, the only news we have is more likely to move. And then somehow, Jay decided that the news between the two meetings made him less likely to move. And that's an example of a policy disagreement I have. And so I would guess that the fact that he came in signaling less likely to move makes the likelihood of them deciding to go 50 basis points lower.
You think it's more likely to do 50 than 25?
No, I think they're not likely to do 50.
More likely to do 25?
I think that's probably what. I mean, I'm reading the tea leaves that they're showing us.
Would that satisfy the president, do you think?
I think that the president thinks rates could be a lot lower, and I agree with him on that.
Okay, so obviously you were one of 5 people that the Secretary of Treasury has on a short list to be the next chairman of the Fed. Why would you want to be chairman of the Fed? Right now, you get to work with the president every day, and he's not criticizing you at all. Are you sure you want that job? And
it's a thing that, first of all, I have to say that I, as you know, feel like I'm the luckiest economist alive, because I have the.
I just wanted everyone to say hi to Violet. Violet, you want to say hi? You gonna take my calculator? Were you calling, Dad? Dad went to the bathroom listening to Kevin Hassett be boring. And then you're like, Dada, where are you? Want to say hi? Go say hi. He's like, who do I say hi to? Just go say hi. Are you going to take my calculator? Yeah? You being shy? It's okay, Violet. It's okay. Just shell-shocked. Shell-shocked. Right? Anyway, okay, we'll go back to Hassett over here for a moment.
I think that helped a lot.
I guess time will tell.
Okay. All right, so you would take the job if you were offered it, if the president offered it?
Yes, we've had that discussion.
Do you have any view on when the president might make the decision or make it public? Would it be this year or next year?
End of this year.
I think that I don't have a view on when the optimal time for that is, and I've not discussed that with the president. I think that people in Washington will understand that a confirmation struggle for a position that's that significant can be quite difficult. And then if it goes on for a really long time, which, we think Jay probably isn't leaving until May, then that just creates like a long period of, confirmation struggles that can be pretty ugly. And so I don't know what the optimal time is, but I would guess that as soon as you do it, then the sort of confirmation turmoil will begin.
Most presidents in the last 25 years or so have supported, and secretaries of Treasury have supported what's called a strong dollar policy, which is to have the dollar be really strong and never support anything that would lower it. This administration has not seemed to be upset with the idea that the dollar has gone down against European currencies by about 10% since the beginning of the year. So is it fair to say you do not have a strong dollar policy, or are you happy where the dollar is now?
Well, this is a group that everybody here probably can go to their computer and put up the dollar chart, and probably has already done it this morning. But if you look at the dollar chart, then it's stronger now than it was when Trump left office, but it's down a little bit from its peak. And I think that the strong dollar policy is a sound policy, and I think that basically, I'd almost say that if I were running any country anywhere, I would want the currency to be sound, because we know what happens to countries when the currency isn't sound. And so I think if you want to have an inflation take care of your deficit, then you're on the road to financial crisis. And so I think that one of the ways that we can maintain fiscal discipline is to be really committed to a strong dollar.
But you're happy with where the dollar is now, relatively speaking, the adjustments that have occurred?
Well, I think that again, if you look at where the dollar is now, it's stronger than it's been. The charts kind of went like this. And so I think that if you were to look at historically, is the dollar strong right now, you would say yes.
So in his career in public policy, President Trump has always been not a big fan of a trade deficit. We've had trade deficits for quite some time. Do you see any progress in the trade deficit as a result of the tariff policy? And do you expect trade deficits to be going down in the course of his administration, or to be happy to just keep them more or less where they are now?
Yeah, the trade deficit is definitely going down, and the fiscal deficit is going down as well.
No, it's not. You're smoking so much crack, it ain't anywhere near to going down. It's negative $1.8 trillion a year, and you want to issue stimmy checks. Come on, man, you gotta be smoking so much crack. I gotta bring the baby away so we can tell you how I really feel.
What it was last year, and
here, say goodbye to Violet. Violet, you want to say bye? Want to say bye? Yeah, you don't believe Kevin Hassett either, do you? You don't either, do you? It's okay, buddy. Okay, we're gonna go back to mom, okay, buddy? You want to say bye? Just go bye. Nope. Absolute silence. Silence!
Biden's team was shoveling money out the window in the last quarter of last year, and so the fiscal year numbers didn't look quite so good, but about 40% of the deficit was in the first or the last Biden quarter. But in the calendar year, it's about a $600 billion a reduction in the deficit relative to 2024. And then the question is, where did the $600 billion reduction come from? And it's about 1/3 of tariff revenue, about 1/3 increased tax revenue, because growth is higher than we expected. We've got these 4% growth quarters, and then the rest is spending reduction relative to last year.
Okay, so right now the budget deficit has generally been for the last couple years about $2 trillion a year, more or less. More or less, we spend roughly $7 trillion a year. We take in roughly $5 trillion a year, and we generally have about $2 trillion deficit. Maybe it's coming down now. But we have about $38 trillion overall of debt. Do you see any way that to reduce that indebtedness in the next couple of years or so, or realistically we're stuck with $38 trillion or rising a little bit over the next couple of years?
Right. Well, to reduce the debt, right, then you have to run a surplus. And so the question is,
good luck running a surplus. All right, Kevin Hassett. He just made Violet sad. That's all he did. All right, so, all right, so what do we have this morning? So we looked at Sonder, which was a crazy bankruptcy story. We looked at the reverse mortgages. We looked at the Epstein files. We looked at the state of AI, which is also wild. We looked at the Meta financials. We got the 10 years plummeting. I wonder if the 10-2 is jumping on this. Let's see. 10-2's at 50. So it's not like it's super, it's still in that like shock prone region. But it's still like no evidence of shock. You've got the Qs that are really struggling today. And that 617 was interesting. But let me go see what the suits are saying today. So, bond rally signals 10-year auction will be more sure. That's fine. Healthy degree of skepticism required for stocks. Valuations at all-time highs. No. Okay, here we go. So what is this? Earnings help cool AI euphoria as even beats get punished. Yeah. Alright, that's a good point. Okay. Let's take a picture of that. I'll share it all in just a sec. Oops, why is it doing that? There we go. Okay. Then we have AI winners take a breather, yeah. Reality returns to a quarter of the stock market. I don't think reality's returned yet. But okay. Yields fall. Potential shutdown to end. You could see that. You're gonna get a lot of data. Besant warned of a hiccup in the economy following the closure. Right. That's what I'm kind of nervous about. Hasn't decided on the 50-year mortgage. I see that coming through right now. Okay. Financials back on clearance. Divergent earnings. Gold set for another leg up. We'll test the dollar. Retail stock buyers are courageously climbing the wall of worry. Right. Because sentiment is declining. Oh, that is a weird divergence, though. I'll have to show you this. This is... Come on. There we go. I think you'll find this interesting. Look at this chart as soon as I can pull it up here. Boom. There it is. Look at this. This is... The blue line is sentiment, and the white line is allocation to stocks. So it's basically aligning sentiment with allocation to stocks. That's wild. Okay. Anthropic, we got the 50 bill there. Bostic says inflation is still the clearer risk. Oh, and what a surprise. He's the one who's getting forced to retire. Well, we don't know that he's getting forced to retire. He just happens to be retiring. So he's going to leave that legacy of, like, focus on inflation. That's interesting. I don't know if there's CPI consensus. Let me see. Oh yeah, no, there is. 0.2 month over month. Core is 0.3. Even though we don't expect to actually get any of this. So wild. It's been like boring without data. Oh, you know, you got the ADP weekly, I guess. U.S. firms preliminary benchmark revisions flagged revision to payrolls. Let's see. That's old. Okay. That's no fun. Okay. So, what else here? 50-year mortgage could make it easier to own a home. You have to remember that what you're really doing is you're just incentivizing demand. And so you're making the people who already own real estate have an easier time to buy real estate. It doesn't actually make it much easier to buy without increasing prices. Well. Okay. We looked at this. Let's look at zero. Zero is something. Sometimes they got something. Okay, let's see. What is this? AI and very, very late stage bubbles. What is this? 2 new warning flags. First, we had the Burry post. That's old news. And then we had... Well, where's the second post? The strains are... Okay. CDS spreads widening. Right. Okay, I mean, we did see the CDSs widening. This is true. Although I do wonder by how much we're still getting right now. Let me see here. So I guess I could pull an updated chart. So this is what people were posting about previously, and that had Oracle at 84 basis points. Let's see what they sit now. We are at Oracle CP. Are these I want the CDS USD 5 14. Yeah, I guess I could take those for the Oracle Corp. Okay, let's see. And then I need line. Can I get them priced? Oh, 83. So it's basically still the same. Okay, and then the other one, so that hasn't really moved. And then the Microsoft, those on a 5-year. They've also spiked up. So really it hasn't changed. They've relaxed a tiny little bit. So no real shift here. Okay, so I guess we can do a little bit of a breakdown because I think AMD is still holding up just fine. Let's take a peek here. AMD's, let's go. You know what we could do is we can compare some of these. So let's go to finance.google.com, compare Meta, and compare this to AMD, and then compare it to NVIDIA and Microsoft. Oops. Oh, I didn't do the compare. AMD, NVIDIA, MSFT, Meta. Wow. Those divergences. I mean, that's all on the day, but let's go to like year to day. Oh, interesting. Yeah, look at that. AMD popping off on the right. All the others are slowing down. You know, and it's only when you put in Apple, it's also at all-time high, so not nearly as much as AMD is up. But you've got a little bit of that relaxation there. That's really interesting. What's going on with the markets today? Oh, the little AI summaries over here. That's cool. All right. Anything else? Fed, AI, streaming prices are soaring, consumers are still paying. Well, that's good for Netflix and Disney, that's for sure. So prices have rocketed on those. So I think they don't even know how much they can charge and how willing people are to keep paying for these. AI boom is looking more fragile. Okay, let's see what we have here. Perfect isn't good enough. Any sign of weakness is a disaster, justified or not. The current mood in markets is the current mood in markets. History suggests that the gloom won't last. But the shakeup serves as a strong, well, hopefully not. Because there have been gloomish periods about AI before. I even remember, you know, the deep sea gloom, or liberation doom. Yeah, you know, you're gonna get those stronger movements of pain. But so far we keep coming back because the printing keeps going on. Generative AI services require massive data center state-of-the-art chips that don't come together quickly. Okay, we know. Even companies posting strong financial results haven't escaped investors' wrath. Meta down nearly 17%. Palantir is down about 8% after respectable earnings. AI spending more than there is AI revenue, a gulf that is widening by the day. Well, I think, who was it? JP Morgan had a piece of JP Morgan AI revenue and how much AI revenue you would have to see. Yeah, here. The path will not be up and to the right. Our biggest fear would be a repeat of the telecom and fiber build-out experiences, where the revenue curve failed to materialize at a pace that justified continued investment. For now, commentary from large corporates suggests benefits are starting to be realized at scale. More interestingly, OpenAI just publicly commented they achieved $20 billion in annualized revenue run rate. However, breakthroughs or accelerated efficiency gains, as people initially thought occurred with DeepSeek, could drive an overcapacity dark fiber situation. Big picture, to drive a 10% return on our modeled AI investments through 2030 would require $650 billion of annual revenue into perpetuity. Okay, which is astonishingly a large number, right? But for context, that equates to 58 basis points of global GDP, or $35 a month from every iPhone user, or $80 per month from every Netflix subscriber. How is that apportioned between corporations, governments, and customers? All that's a debate. Regardless, even if everything works, there will be continued spectacular winners and probably some spectacular losers. Right. I mean, but how many iPhone users are there? This is of global GDP. You know, $34 doesn't sound like a lot in the United States, but it's a big deal when you have international people using older iPhones, right? Global iPhone users, how many do you have? So you have 1.5 billion iPhones. How many Netflix users? 300 million. Right. I mean, that's like every person in America. You'd have to divide it by, to get every person in America, you'd have to divide it by 5, or multiply that number by 5 to just make it America. So to make this just America, it would work out to, you know, every American paying somewhere around $180 a month. I think that's actually a little bit, yeah, because it's more like that Netflix revenue there. Every American, children included, like $180 a month. Yeah. Interesting. Okay, so then we have OpenAI is already projecting that losses will swell, so skittish mood has become, defends this company X, understandably causing concern, pointed to plans, blah, blah, blah. Huge amount of leverage. Oracle reached $300 billion deal to supply it. $18 billion bond sale. AI-related companies issued $139 billion of corporate bond last month. Wow! $139 billion of corporate bonds just last month. Bro, that's a lot of debt. Little sign that the underlying spending boom is stagnating. I mean, that's true. That's good for AMD. I wonder if the MSA is out yet. Come on. Nope, not yet. All right. Cool. What else?
Who support the thing that he's being advised to do and the people who don't. Unless, obviously, there's some things that everybody supports so much that you just can't do that. But he really likes to have lively debate in the Oval. And if you're not giving him enough debate, he'll work it out and make sure you get
when you
debating.
go in there, when you debate with him,
they're just talking about Trump and that. All right, whatever. All right, let's talk about the meta thing a little bit and this AI debate a bit. All right. Let's sum this up. Let's talk about the AI valuation debate and the fact that we might have a canary in the coal mine telling us that things might go poopy-doopy a whole lot faster than people think. Now, that's not to be bearish, because obviously right now we're looking at AMD absolutely crushing it. In fact, we were breaking down some of the AI numbers for AMD, and they're actually really phenomenal. So if I jump on over to my stock tab and then pull up just AMD, some of the numbers that I see are gorgeous. First of all, right now with AMD trading at just 1.4 times on a PEG ratio basis with 45% growth average expected for the next 4 years. AMD could easily have a reasonable $480 price target, which is absolutely phenomenal. And it makes sense why AMD is up 7% today. It was up as high as 10%, which is great. But the rest of the market is a little more tenuous. Is it potentially because of a canary in the coal mine? We're going to talk about that. First, a little sum here on some of the AMD stuff and why it's so interesting compared to NVIDIA. Right after I wet the whistle. Okay, so the thing about AMD you have to remember is AMD is in a place where they only make 46% of their revenues from data centers. NVIDIA's at 88%. So what's happening is as they blow up their top line because they're getting more access to manufacture chips through TSM or whatever, more people say, hey, I want these AMD chips too, this is great. AMD can increase their revenue without actually increasing their OpEx, which means their bottom line finally starts growing. NVIDIA right now brings 4 times as much money to the bottom line as AMD does. So obviously a lot of people are really excited about the AMD boom, and it makes sense because AMD's Lisa Su says, look, there are very clear forecasts from cloud customers. OpenAI deal plans are in the works. We're confident on supply. Operating margins are going up. Inference is growing. The total, here we go. This should be a red flag in its own. Total addressable market for chips, $1 trillion by 2030. This is phenomenal, right? These are huge, huge numbers. So if we just look at AMD, everything's fine. But then, why all of a sudden are credit default swaps for Microsoft and Oracle starting to spike up? And why are we seeing some canaries in the coal mine? Well, what I like to see is what happened historically when businesses got really excited about blowing money. You might remember when Facebook changed their name to Meta, Mark Zuckerberg was blowing money on the metaverse. And right now, a lot of people think that Mark Zuck might be going in the same path, blowing money on tech infrastructure that may not actually pan out, especially when he's on record as being the guy that says, hey, look, we would rather overspend on CapEx than get left behind. So Mark Zuck is kind of doing his drunken sailor, we'd rather overspend on CapEx than miss out. Microsoft's CEO is like, hey, even if our OpenAI investment goes to zero, we should be okay. Like, we're fine. And I want you to align those sentiments with their stock, and you're going to start seeing where the canary in the coal mine is. Take a look at this. Meta stock is down over 22% from its all-time highs, and people are pissed that Mark Zuck might be doing the drunken 2021 metaverse crap again, where you overspend without seeing ROI. People are nervous about Microsoft, but it's only down 10% off all-time high because you've got a CEO that's like, even if some of this went to zero, we're still making a lot of money. Guess who's not spending a lot of money on AI CapEx and is at all-time highs? Oh, Apple. Wow, what a surprise. So the market is starting to punish businesses that are overspending on CapEx. Now that leads to your Michael Burry concern. Meanwhile, in the short term, it's great for AMD. It's fantastic because what Wall Street is going to do is they're going to take projections of growth for AMD and they'll apply them to infinitesimal or into infinity, because that's basically what you did with NVIDIA, and it worked for NVIDIA because the AI boom has been going now for like 3 years. It's wild, right? We're coming up on 3 years since Q1 2023. Absolutely insane, 3-year boom. The problem is when you actually start looking at the numbers of, let's say, Meta, you're like, no wonder they're starting to get into off-balance sheet financing. And no wonder everybody's starting to get a little worried about debt. I mean, consider some of these articles and numbers here. First things first, and we've been through this before, but look at all these companies that have massively beat. Almost all of these companies here beat. And a lot of the stocks have fallen after big beats. So you've seen beats across the board, yet stocks that have slowly melted. Like, Palantir was an example. You got a little bit of a bleed after a really good beat. Some of that may be because there's this really big mismatch between consumer sentiment, so daily consumer sentiment, and consumer allocation to stocks. Usually these lines align. Usually when sentiment goes down, people's allocation to stock goes down. There is a little bit of a lag, it appears. But right now, we're still spiking on allocation to stocks, which is the white line, while consumer sentiment is falling off a cliff. Now, some of that could be because maybe people are starting to say, hey, we're starting to get pissed about the CapEx a little bit. Look at this. Here's a Wall Street Journal piece talking about the CapEx and talking about how this infrastructure spending is a big concern. Specifically this line right here. Goldman Sachs is reporting that $139 billion of corporate bonds have been raised for CapEx spending. Meta is literally going and doing this off balance sheet, which I actually think is brilliant for Meta, mind you. I think it's very, very smart because there's not much room on this balance sheet anymore. Here's the Meta balance sheet, okay? I've got $44 billion in cash plus $17 billion coming in, which is great. That's $61 billion versus the $37 billion in bills that I have. That's fantastic. That's good. But some of it is a little fugazi because we still have 51 or 52 billion in long-term debt, and we're leasing these data centers via $30 billion of off-balance sheet debt that we're not seeing, but we're still obligated to those lease payments. So when we actually go over here to these lease liabilities, we actually should have a giant asterisk right here on these lease liabilities, which, right now cost them $2 billion. On a long-term basis right here. Well, that's the current, and then long-term lease liabilities we have right here, the non-current portions right here, $20 billion of leases that they have to pay. Right, there should be a giant asterisk here because Meta is committed to make lease payments, though the way they've been able to finagle their accounting is they don't actually have to include their lease payments on this new $30 billion center in this balance sheet. So we're definitely getting some creative financial engineering to keep the debt bubble going. And I think investors are starting to say, hey, we're not comfortable with all of that. Now, I actually think that Meta is awesome from an advertising point of view because I think what you're going to see is you're going to see this movement of people realizing that AI chatbots just aren't all the rage. And so then there's going to be an advertising war. So Meta, Netflix, Disney, YouTube, they'll benefit from this advertising war of trying to promote, use this chatbot, not that one. Gemini's better versus, ChatGPT or whatever. They're all going to kind of end up at the same place, and then it's just going to be what you get used to. Are you used to pulling up Uber or are you used to pulling up Lyft? Anyway, here's a McKinsey piece that just came out on artificial intelligence, and it says that most organizations are still in the experimenting phase when it comes to artificial intelligence, and that AI spending might be useful at redesigning workflows, but basically when you go through this piece, what they find is that everybody's kind of already using AI for at least one function, like the vast majority of people are using AI for one function, but we're not actually seeing AI agents scale up. And there's still too many concerns with these agents or AI bots in general making too many mistakes, which might be limiting their actual bottom line impact on EPS. So in other words, we're not seeing the impact yet on earnings per share. A lot of people inside corporate organizations, this survey, by the way, 83% of these survey results came from businesses with over $1 billion in revenue. So we've got a very big concentration of answers from massive companies here, and the answers are that we'll, like most of us, almost 90% of us are using AI for at least one thing. We use AI 70% of the time for two things, but then it kind of drops off. And so what happens when we start plateauing on growth? Well, that's where I think not only do advertisements have to explode for which AI software or service to use, but then it also makes you scratch your head like, are these AI services really that unique? And how much money actually needs to be raised to keep the AI bubble going? See, like The Information has this headline, from Snowflake to Sierra, every enterprise software firm is selling the same AI agents. Right, like what's the difference? Hey, which bot do you want to use? They're all the same. This was a good post as well. Oh, he put me through Cloudflare. Thanks, X. This is so stupid. Anyway, I was just gonna pull up this X piece, which apparently now in the middle of this, X logs me out on, but it's okay. Don't worry. Basically, we pulled this up and we saw this JP Morgan post where they essentially say that if every iPhone user were to actually create some kind of ROI for AI, they would have to spend about $31 per month. And then I'm like, all right, well, how many people use iPhones? Because that's going to include, here, I found it. I just pulled up my old live stream since X has apparently kicked me out. Maybe I got banned. It's okay. It's all right. We got YouTube and we got the Meet Kevin app. But anyway, here's that piece. So the biggest fear, JP Morgan says, is a repeat of the telecom and fiber build-out experience, where basically we overbuild on CapEx. And commentary right now is that we're still booming on CapEx spending, but let's be real. To get a 10%, this is just a 10% return on all of the AI spending between now and 2030, we would need every single iPhone user in the world, which is a 1.5 billion humans who use iPhones, to spend $34 a month. Now, that doesn't sound like a lot when you think about it, because it's like $34 a month. A lot of us are in first world countries. Great. But wait a minute. Let's just assign this and just say U.S. population. If we just said every human in the United States needs to pay for this, you'd be around $160 per month that every human needs to pay in America for artificial intelligence every single month to justify a 10% return on the CapEx spend that's gone into AI. And then when you look at it, it's like, damn, if you have a 4-person household, that would be like 160. What is that? 160 times 4. That'd be $640 per month that you would have to spend in your household to justify a 10% return. That'd be crazy. Like, those are insane numbers. And the fact is, a lot of these products are the same, and they're still quite error prone. Not only hear what the information is saying, but what McKinsey's saying. This is why we're so excited with what we're doing with our AI at HouseHack, because we feel like nobody is doing real estate-based AI that's like, hey, this is potentially a good deal you should be looking at relative to other deals in your neighborhood. And then in the future, we're going to even be coming out with sort of a net worth difference where we're like, hey, if you buy this deal, your net worth could go up by X, and you should spend less than X on the kitchen. And if you do, your net worth will go up by this number. Like, basically using my machine learning and renovation strategies to teach the AI how to find the net worth boost to you by doing a bathroom reno, a kitchen reno, and licensing basically how much you could spend on those upgrades. Like, to me, that's useful AI. But all these like agents and stuff, they're so ubiquitous, and that's the big concern right now. And that's why I say I think Meta is becoming, here are the errors, people are worried about inaccuracy, cybersecurity, regulatory compliance, blah, 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 blah. These are just some issues that people have. 1/3 of all respondents reported consequences stemming from AI inaccuracy. Inaccuracy is one of the 2 main risks. And 51% of respondents say AI has seen at least a negative consequence, at least one negative consequence. Well, of course. I mean, like, don't get me wrong, I'm not bagging on AI. I think there's some really cool things you could use it for, but it's a tool. It's a tool on your tool belt. And if you overly rely on a tool to do everything for you, you're going to fail. We know that. This is old news. But what's really interesting is I want to pay a lot of attention to Meta, because I actually think that Meta's valuation is the lowest out of the Mag 7s right now. If I go look at Meta right now is trading for a 1.19 peg. This, by the way, is in our Meet Kevin app for Alpha Report members. But I think that they are, the biggest risk here is that they're going to be the first casualty of AI overspending. They'll be a great opportunity as an advertiser, but you'll go through a dip first. So if you want to buy the dip on this cheap one, you probably either A, want to be patient, or B, be slow. Buy the dip slowly, right? Because you might get better opportunities. But the way to look at it is, what happens when all of the other companies start realizing, damn, we're getting punished. The more we spend on CapEx, the more we're getting punished. I mean, Amazon so far hasn't really gotten hit yet because Amazon's at all-time highs. But Amazon's free cash flow just went to 0. If you haven't seen it yet, it's worth looking at. Investor Relations, Amazon. And what happens is, this is how the cycle kind of transitions. When people start getting pissed off about Meta overspending and the stock goes down, all of a sudden you'll have Mark Zuck change his tune and he'll start saying things like, actually, guys, we're going to be a little bit more cautious on how we're spending money here, and we're going to chill out a little bit, and we'll spend less. And then if the stock goes up, then the other Mag 7s start going, yeah, we need to be cautious too. That then destroys the demand estimates for AMD and NVIDIA, which then potentially reduces the value of chips, which then reduces the depreciation curves, and then Michael Burry proves to be right. If you watched my full Michael Burry video and not just read the title, you'd actually see that I think Michael Burry is wrong today, but he's right in the long term, that these depreciation curves are insane. But look at here. This is Amazon. This is Amazon's cash flow, 3 months ending September 30th, 2024. And we can see that their free cash flow was about $3.3 billion in 2024. That free cash flow in 2025 has basically gone to essentially zero. I mean, it's about $500 million, which is still pretty good. But it's for Amazon, it's basically zero. It's almost indistinguishable. Their cash flow has exploded, their capital expenditures have exploded so much. Their cash flow, free cash flow, is essentially zero. And that's such a big shift from where we have been. And so, of course, this is why I keep refreshing the I keep looking for the MSA at CoreWeave. Because once it comes through, only thing I see here is an insider sale at CoreWeave. But CoreWeave is an interesting one because they're going to be one of the long-term bag holders. Not necessarily in the short term. But in the very long term, CoreWeave is one of those companies that's bag holding chips. The MSA, though, that's going to get released will show how much of NVIDIA, or how much NVIDIA is sort of guaranteeing the bag that CoreWeave has. So CoreWeave has a backstop by NVIDIA at $40. But they also have this other backstop where they're like, oh, well, we'll buy your unused data center capacity. Okay. Well, we want to see the details of that. The details are due after the CoreWeave earnings. CoreWeave earnings just came out 2 days ago. Still haven't filed it. So they're overdue right now. What are you hiding? Is it because the stock's going down? I don't know. I want to see the details. But I could see that frustration beginning to build again around Metaverse, and I think that's why Facebook is getting hit the worst, or Meta's getting hit the worst. And if that doesn't go away because, we don't end up getting a good jobs report, or we don't end up getting good catalysts in the market, that could become self-fulfilling. So the more Meta goes down, you might not be an investor in Meta, and that's fine. But the more Meta goes down, the more it's a red flag for the entire stack. That's important to pay attention to. The entire stack gets hit if Meta goes down because of this, the CapEx spend. Somebody's like, it's the glasses, bro. I don't think anything that this has really anything to do with the glasses. It's such a small part of their business and the advertising segment. I personally, I think glasses will be ubiquitous. You'll have, Apple will make some, Microsoft will make some. Like, you don't buy Metaverse just for the glasses. It's crazy. The only reason you buy Meta is because you think they're an advertising powerhouse. It's the same reason that you want to get into like Netflix potentially, where they're starting to now see really, not only a downturn, this downtrend that they're on, they're nicely bouncing at 1088, which is great. But this is a cash generating behemoth, and they're just getting started on advertising investments. And what's remarkable is, you might not have realized this, but have you recognized that Netflix is worth just as much as Palantir? Think about that for a moment. Netflix is worth $490 billion. Palantir is worth, close, $435 billion. And that's because they're down, 10-ish% from their high over here. Otherwise, they'd be roughly the same as Netflix. Now, I want you to think about that for a moment. Let's just compare some of those numbers. Let's go to here. Let's go to their cash flow. We'll just use Webull to cheat for a moment. So look at Palantir's net income. So Palantir has net income of $476 million. And they have cash flow, or net income here. Cash from investing, capital expenditures are basically nothing. So we've got let's just call it net income here. Net income of $476 million. Now Netflix on the flip side has net income in the same damn quarter of 5x that, $2.5 billion. $2.5 billion, and they're the same market cap. So think about that for a moment. The multiples here are absolutely insane. If I go to Palantir Investor Relations and we pull up Netflix Investor Relations, this is the benefit of staying towards the end of my segments, is you get this extra insight. So let's see here. Let's go to Q3 earnings. Q3 earnings. Get the letter to shareholders. Perfect. Okay, great. So here we go. Palantir has EPS of 18 cents. Cash from operations, $500 million. Okay? Here's Netflix. What do we have with Netflix? Netflix. Net income, we've got Q3, $2.5 billion. Earnings per share of almost $6, which is insane. The year-over-year revenue growth, year-over-year, 17%. Now, that's probably where Palantir is going to kick our butt on Netflix because their year-over-year revenue growth has been growing. That's why their multiple is so much higher, right? Year-over-year revenue growth is right here. So year-over-year rev growth. Oh, Violet took my calculator. Crap. Okay. 1.1181 divided by 725. 62%. So the growth rates at Palantir, that's why people are paying big dollars. Yeah, here, they round it to 63%, whatever, 61%, which is fantastic. It makes sense. But when you actually look at the bottom line, it's kind of remarkable that they're the same market cap because of the hope that this growth keeps happening. 18 cents of earnings per share at Palantir, 500 million cash flow. Over here, you've got, what is that, 20 times as much earnings per share and 5 times as much net income, or 5 times as much free cash flow, almost 6 times as much total cash flow. It's crazy that they're roughly the same valuation, which in my opinion isn't to be bearish Palantir. I mean, maybe some people can glean that. It's actually more to be bullish Netflix if we get a nice soft landing. Netflix, by the way, is not doing this insane AI build out that Meta and the others are doing. So from a Mag 7 point perspective, it's actually not that expensive either. Meta's cheaper, but I mean, hey, you don't have that downside CapEx risk that you have. If I look at Netflix from a financials point of view and do financial analysis on Netflix, just to get a quick look here, I've got roughly $25 of expected earnings per share. The stock is trading for $11.56, and they're going to do their stock split here, divided by 25. They're trading for 46 times, and their growth, this is so much easier when I have my little calculator, their growth over the next 4 years is expected to be 17.5. 17.5. So they're trading for about a 2.6 peg, which is, I think, actually a fair price. I think Meta's trading cheap, but I think Netflix is at a fair price without that CapEx risk. Kind of interesting, this whole canary on the coal mine and the coal mine thing. Very, very interesting. In addition to obviously the big split that Netflix is doing. So very interesting to me. Somebody says, so Burry's right on Palantir. Well, I mean, high peg's almost always correct. Palantir's trading for like a 7 or 8 peg. Their earnings are great, but one of the reasons it's so high is just really momentum. That's why Netflix is more of this, like Netflix had all this momentum, and then what happens? You just trade sideways once the momentum goes away. It's really hard to stop the momentum when everything's going straight up. Here's Apple, for example, or here's Palantir. It's been a phenomenal rally at Palantir. It's only been up and to the right. So you just can't blame it. But yeah, that does create the substantial risk that there's major overvaluation in certain stocks. But that's okay because they create opportunities to pick up shares at a cheaper price. You just don't want to get margin called on the way down, right? Cool. Did Carolyn Levitt just say that GDP could be down 2%? What? No way. Let me see. I want to see that. Okay, let's see here. Let's see. Carolyn Levitt.
Pay for free healthcare for illegals. In fact,
oh man, dude, her voice is so minister of propaganda. It just drives me nuts. I'm sorry.
reckless government shutdown on for weeks longer to boost their
Just drives me nuts.
Missed their SNAP benefits. Nearly 20,000 flights at airports across the country.
Leadership safeguarding the American public is achieved every single day. Thank you. Thanks, Caroline.
Thank you so much. Appreciate it. Okay. Thank you again, Director Patel. Before we get going, I do have one quick scheduling announcement. Tomorrow, President Trump will be joined by the First Lady in the East Room for an executive order signing aimed at expanding opportunities for education, career development, housing, and other resources for young people transitioning from foster care to adulthood. This is part of the First Lady's Fostering the Future efforts, which are a Be Best initiative. 3 days, the longest shutdown in U.S. history. But tonight, thanks to Republicans, the White House is very hopeful that this shutdown is going to come to an end. The damage caused by the Democrats with this reckless government shutdown cannot be forgotten. It is entirely the fault of the Democrat Party. Just look at the vote count. Hundreds of thousands of federal employees have missed their paychecks. Tens of billions in wages and benefits were withheld, impacting vulnerable families. Millions of low-income Americans missed their SNAP benefits. Nearly 20,000 flights at airports across the country were delayed due to staffing shortages, causing Americans to miss family events, vacations, and work obligations. According to Airlines for America, an estimated 5.2 million travelers have had their flights disrupted over the course of the Democrat shutdown.
Okay, where's the GDP
and our
part?
economy has lost billions and billions of dollars in economic activity over the course of this shutdown, hurting consumer sentiment and crushing the travel and hospitality industries.
Okay.
According to a CBO estimate, the Democrat shutdown could end up decreasing fourth quarter economic growth by 2 whole percentage points.
Wow.
The Democrat shutdown made it extraordinarily difficult for economists, investors, and policymakers at the Federal Reserve
Hold
to
on.
receive.
Let's see here. I'm going to pause that for a second, and then let me go to the doomers here. That is interesting, though. Good call out.
Concerning thing to me then, missing those data points. But, you know, we saw the president a couple times in the last week say inaccurate things about how prices are down. We saw that Walmart report about a Thanksgiving meal costing less when, in fact, they were just moving around all of the items that go into that. I think the more and more that the administration tries to rely on fuzzy private market data as they, you know, withhold that information about the typical reliable government reports, that to me is more concerning.
I did want to ask you also about the broader backdrop of the economy here when it comes to tariffs. You brought up tariffs. It was also part of this conversation that we just heard with Kevin Hassett, and he said that the administration is considering some of these other tariff authorities as the Supreme Court looks at the big one, IEEPA, those broad-based tariffs based on emergency powers. We heard President Trump earlier this week suggest that there could be $2,000 refund checks. How do these headlines jive when you have the administration looking at dispersing money from tariff revenue, but also preparing a backstop if those tariffs get struck down?
You know, in the Supreme Court arguments last week, we really saw the solicitors struggle with how to respond to questions from the justices about these revenue effects of the tariffs. They say they're minor. The president tweets out that they're going to be $4 trillion. The president truths again that they're going to be $3 trillion and they're going to fund stimulus checks. I mean, it's really all over the place and quite incoherent. I'd say on the checks, I am not running out to put $2,000 $100,000 on my credit card because I think the government will be sending me a check in the next 30 days. And I would not suggest that anyone else do so. And then, I think we're likely, even if the Supreme Court does weigh in on those emergency IEEPA tariffs, the Trump administration has signaled, and they have even started, over a dozen investigations using those other authorities on specific inputs. So that could be, copper, aluminum, semiconductors, but we could see those spread to other industries using other authorities, some of which, could allow him to enact time-limited across-the-board tariffs of 10 to 15%. Others would require 6-month, typically, investigations before they could put higher rates on them.
So there would be an interruption then, waiting for the next round of tariffs to come in that world. Would the money need to be paid back during that period of time?
There won't be an interruption. Trump will immediately just start collecting it through something else and then fight courts tooth and nail. Like, if the Supreme Court really wants to kill tariffs, they need to kill all methods of tariffs. And that's going to be a big pill to swallow. Now, this is interesting. I found the CBO piece. This is what I was looking for. So this is the CBO government shutdown Q4 GDP 11, 12, CBO government shutdown. All right. Letter presents the estimates of the effects of a shutdown that lasts, a shutdown that ends after 6 weeks on November 12th. Dude, how did they know? It's like literally to the day. That's freaky. All right. Depending on the length, the government shutdown will reduce annualized GDP in the quarter by 1 to 2 percentage points. After the shutdown, GDP will temporarily be higher than it has otherwise been. Right. Although most of the GDP decline will eventually be recovered, CBO estimates that between $7 to $14 billion will not be. Okay. Right. So you'll have, another shake in the actual GDP forecast. GDP will be lower than an absent would have been. Okay, so this is where she read that from. And then, of course, she's not giving us all the context. She's just sort of like, Trump external legal counsel has filed a lawsuit against BBC. Well, they said that would happen.
October CPI and jobs reports likely never being released. And all of that economic data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period. It's hard to recap all of this without asking a simple question. Why? Why have the Democrats put the American people through this pain for 43 days in a row? And it feels like Groundhog Day being up here again talking about this Democrat shutdown. And the answer to that question is pure partisan politics. They started this shutdown with a ridiculous demand to force taxpayer-funded healthcare benefits to illegal aliens who broke into our country. Even after it was clear President Trump and Republicans would never force American taxpayers to pay for free health care for illegals. In fact, President Trump's One Big Beautiful Bill fixed that problem. The Democrats kept dragging this reckless government shutdown on for weeks longer to boost their turnout in an election, perhaps one might guess. That's because the Democrats are totally captured by their far left-wing base who only care about attacking President Trump, even if it means hurting innocent Americans in our country. The Democrats' weakness and their unwillingness to buck the fringe members of their party dragged this harmful shutdown on for 7 weeks and inflicted massive pain onto the American public. But let's be clear. The clean CR being voted on today in the House of Representatives that will lead to the reopening of the federal government is what President Trump and Republicans have supported from day one. Our troops, air traffic controllers, and federal employees will be back to receiving their regular paychecks. Families in need will get back to receiving their food purchasing assistance, and the people's government will soon be back open for business. President Trump looks forward to finally ending this devastating Democrat shutdown with his signature, and we hope that signing will take place later tonight. On another matter, I want to address the affordability issue that's received a great deal of media attention this past week, which is ironic because it didn't receive that much attention when Joe Biden was here and inflation was at a record high 9%, the worst inflation crisis in modern American history. And President Trump won a landslide election in part to address the affordability issues created by Joe Biden and the Democrats. And that's exactly what President Trump has done since day one of his administration. Since the first day in office and every day since, the Trump administration has taken aggressive action to fix the Biden-created cost of living issues. The notion that the same Democrats who just shut down the federal government to sabotage our economy, rob people of their paychecks, and also helped Joe Biden ratchet up inflation to 9% are now suddenly affordability champions, that notion is completely absurd. And it's something only the liberal media would have the gall to push. But the reality is that President Trump and his administration have done so much to lower prices and increase the economic prosperity of the American people. And this president and his team of amazing economic advisors are going to keep working on this issue every single day. In less than 10 short months, President Trump signed the largest middle-class tax cuts in American history, including no tax on tips, overtime, and Social Security, which will guarantee that next year Americans are going to put more money back into their pockets. The president has completely unleashed American energy dominance to help bring gasoline prices to the lowest in 5 years, and we expect them to continue to decrease. And it has also lowered energy costs overall. There is more work to do, but again, the president's deregulatory and pro-American energy agenda is absolutely going to continue to drive down prices. This formula worked in the president's first term, and we expect that it's going to work again. And this is key because we know energy costs are the #1 driver of inflation. Again, just look at what Joe Biden did to our energy industry over the past 4 years of his administration, and look at what happened to inflation as a result. Everything became more expensive. To lower prescription drug prices and healthcare costs, the president has been working around the clock on this issue. He is obsessed with negotiating these good deals on behalf of the American people to bring down pharmaceutical costs and drug costs for Americans, and he has done so on a number of fronts. You have seen him discuss that in the Oval Office several times. To fuel small businesses, lower their costs, and incentivize hiring, the Trump administration has already cut 30 unnecessary regulations for every new one on the books, which we know will save employers and small businesses across the country thousands of dollars in regulatory burdens. All of these pro-Trump policies are working, and they will continue to work. Wages are...
We'll see about that. All right. I don't think that, I mean, the GDP thing isn't really that surprising, and it's not really, like, too newsy, because it's sort of like, yeah, it's going to go down, and then it's going to tick back up again. But, I mean, look at the Atlanta Fed GDP estimates. It's insane right now. They're estimating 4%, you know? So this keeps going as long as jobs stay up, right? So it's kind of exciting. Good for the economy. And then it's just a matter of, like, where do you pick an investment? Kind of crazy. So, what else is going on here? Q's still somewhat stable today. 617 bounce here. And what else? Apple's flat. Tesla's down a couple. Oh, lost 433. I think it's going to 414 pretty rapidly. 101 BTC. Yeah. All right. Cool. Well, that was fun. I gotta go. Go check out House Hack. Go to househack.com or reinvest.co. Read the offering circular. See you in the next one. Get the alpha report. It's awesome.
Kevin's somebody we'd consider. Kevin is fantastic too.
Kevin is very talented.